Okay, I think everyone can hear me. So we have the futures open, and it looks like it's trading still above the 6-day moving average. Both the all three or four of the indices, the S&P, the Nasdaq, Russell, and the Dow, and that's fine. But today's market was a little bit, I don't know, biased toward the large caps, especially Apple and actually just Apple. Okay, well that's fine. So the market continues to the S&P. So this is actually, when we have, so as you may know, I run a fund. Okay, the fund is managing right now $5 million, 5.5, and what we do is, you probably don't know this. This is from you should probably get like a different perspective of things. But as option traders, we're looking to capitalize on leverage and then quick moves based on news or setups, and that's how the option traders live and die by. Just 1 second, I just need to get something. Yeah, sorry about that. Can everyone hear me? Testing 1 2 3. And let me share my screen. Can everyone see the screen at the moment? All right, thank you. So what was I saying? Okay, so today, very, very weird, right? I guess if you got lucky on that Apple, I other than the trend, all we know that is Apple's trending into earnings. Usually, Apple doesn't have such a strong earnings run, but today's market very, very weird, and usually when we trade in the markets, especially with options, we tend to kind of look at setups. We tend to kind of rely on the market internals. We tend to rely on a lot of different things, especially kind of staying away from Wednesdays. But in some cases, Wednesdays are really, really bullish. Okay, but like I said, it doesn't happen all the time. It's like maybe 20% of the year, Wednesdays are bullish. Today we had the Fed come in, and we had Jay Powell speak, and he did his thing. However, even though the futures were higher today, and I think I saw pretty much every single ticker, all 43 that I'm watching on the radar, green, it ended up being red at the end of the day. And these things don't happen very often, but when they do, it really sucks. Okay. So we try to kind of, these focus sessions are just kind of sessions where we kind of recap on the things and the common things that happen in the market so we can prevent it from happening again. So for example, next Wednesday, especially if there's a Fed, right, then we probably want to trade extremely light, 1 or 2 contracts. You don't always have to make a big win, okay, in every single trade you do. I'm gonna talk about later how to make conviction trades, okay, where the position sizing goes up to 15 to 20%, depending on your net liquid. But you can kind of see that some of the positions that we get into on Wednesdays, especially if you follow the past ledger. Let me see if I can pull it up here. you can see that most of the trades, especially for onboarding that we've been keeping track of, we also have the premium alert ledgers. Wednesdays are not the greatest. Okay. And if you look at your trade history, you'll see that a lot of your profits have been made on Monday and Tuesday most of the time. Okay. And then it distributes maybe a couple of profits in Wednesdays and Thursdays and Fridays. Right. So if I had to share the experience based on the numbers, profits, and number of trades that I've taken with everybody here, it seems like all the money that I've been making has been either on a Monday or a Tuesday and a Thursday and Friday. Now, very rarely, as you can see here in the ledger, trades 1 through 30, we make profit on a Wednesday. So we made profit on this Wednesday and we made profit on June 30th. Very, very rare. Okay. And we even made money on Airbnb. Okay. Even though that's not really part of a TGIT, but that was a Canadian stat holiday and that had the best looking setup because we wanted to take a stat holiday trade. So like if you're going to trade options, then you got to pay attention to the timing, right? Not only do you have to pay attention to maybe how you open up a trade or how you close a trade based on the day, the time of the day, but you should also keep in you should also keep in mind of the day of the week. And then if you think really outside the box, then you should also think about month of the year. Okay, it's kind of like your time frames. You're like focusing on a 1 minute time frame, then a 5 minute time frame, and then you kind of, all right, well, 1 and 5 is a little too volatile for me. Let's go and outside the box. Let's go outside a little bit more. Let's use like 30-minute candles to 78-minute candles, and then you're fine with that. And then you want to look for some home runs. So let's go to the daily and the weekly. Okay, so this is just a summary again. Timing is very, very important. Timing doesn't necessarily mean only execution for option traders, but it just also means that like the day of the week, also the month of the year. We did have some clues from the market internals on Monday, 2.36, I believe, and we're expecting that profile from Monday to develop into everyone's best trade in the world day. But that if it happens around in the next 2 days, which would have been Tuesday and Wednesday, then what we can conclude is that we did not get the best trader in the world day, and we have to understand why. And they think the main reason why is that the Fed has their hands in the fruit punch. So it's a little bit. It tastes a little nasty right now, and we have 2 Feds speaking tomorrow, Jay Powell and some other guy. And you have to think about why there's a dual action being set up on Thursday, where Thursdays are technically one of the best trading days of the week, right? So that's where we usually open up TGITs. I think a couple of TGITs we open up on Thursdays. Well, here it didn't do too well on Roku, but a couple of Thursdays, Thursday to Friday, that was a good one. And then we opened a couple of Monday, Thursday, Friday, Friday, Tuesday, Thursday, Friday, then Thursday, Friday, Thursday, Friday, Friday, Monday, Thursday, Friday, 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 Tuesday, Tuesday, Friday, 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 Friday. Okay, so yeah, I mean, just going through that list, it seems like Thursday is not the greatest. And so when we combine that knowledge, right, and we want to be careful with our risk, and it's okay to go through losses. Okay, like if you're drawing down today, hopefully not a lot, but if you're drawing down, right, then always remember you have a strategy that you can fall back on and rely on. Okay, and that's the TGIT, TGIF. And you have to be very careful, because if you start blowing up your account, right, which I don't think anyone has, you're not gonna be able to participate in that trade. And you should keep your campaigns, your trading separate from day trading setups to strategy-based setups, like TGIT. You got to keep them separate, because if you start to overlap them, you get a gray area, and that gray area makes things a little bit confusing unless you keep track of it through an Excel spreadsheet. So very, very important to understand this. The timing here for this week, due to the Fed, is going to make things a little bit complicated. And we saw a great example of that today, because everything was ripping up higher, but only the FANG stocks continued to move higher. And we talked about that. We said that Apple year to date was negative, and now is actually finally positive year to date, which is a good thing. However, the bad thing is we're not in it. Well, most of us are not in it. So let's go through the focus session together and then talk about the plan. So here's the last session, and just a reminder for all those who are new. So we're going to hold these sessions. These are sessions where you get to ask any questions. You can even raise your, I guess you can ask a question here too, and I'll unmute you. And this is a session where you can actually have a dialogue with me and ask questions about, why did you do this, Roger? How come you did that? You can always have that dialogue with me. But we have these live focus sessions because we want to focus on we want to focus on what we're designed to do, especially what I've been designed to do. And that's been trading from Thursday, Friday into Monday and Tuesday. Now, of course, not all TGITs and TGIFs work well, but when they start working, they work amazingly well. You can grow accounts really fast, okay? And you'll be surprised how fast you can grow an $800 account to 30,000 if you just kind of focus on what is most important when it comes to trading, and that's timing. Okay, so we talked about timing in a very abstract, well, actually detailed way. So let me reiterate. So when we take a look at the ledger, that ledger is important because it's a testament of what we have been doing. Okay, it cannot lie, right? It's a record, and we call it a ledger. And we go through the ledger because, first of all, it allows us to understand what we've been doing, what the record has been showing, and what we can understand from the past, so we can do what we do best: forecast the future, or assume the future is going to be something that has happened in the past. And that's what we do most of the time. Now, when we understand that the timing is the most important part of options, okay, if you don't care about time, then just start selling some strangles, do some iron condors, sit on your butt, and then manage it if it goes against you, and do whatever you want. And that's fine. If some people like to kind of trade in that manner, that's fine. It's a lot slower, and for me, I don't think that for my personality, I don't think that just sitting around and having my brain just sit there and watch those things decay is that fun. I want to look for those big home run trades and then plan some interesting strategies where I can compound my profits. And that's what the whole point of this focus session is going to be talking about, is how we're going to be doing that going forward, so we can make sure that we don't overtrade. And if you do overtrade, make sure you're overtrading within, obviously it's like drinking. Don't drink more than you can handle. Try to take a couple sips, maybe 1 or 2 contracts, but just keep it reasonable, especially when you are dealing with a specific week and with a specific entity. And we're dealing with a specific entity as we speak. That's the Fed. And again, we have a Fed speaking tomorrow too. We have a duo that's going to be in the markets, spiking the fruit punch again. And we've seen it before. They usually dump it and then pump it, or they pump it and then dump it. So they usually say something like, Jay Powell maybe says something about inflation, how it's too high. Market reacts, starts getting smashed. And then the other Fed, the president, will come out and say, inflation is actually not as high as we expected, and the market rips higher in the last hour of the day. Okay, it's almost done to perfection, and we will try to trade around it. But and like I mentioned before, we do have some interesting setups. We have a lot of positions that are in the sell short position: Shopify, Boeing, Tesla, Nvidia, and that's not good. Okay, honestly, when I see almost $2.5 million of people's money shorting the market, trust me, from a person, as you may all know, I'm 80% bullish America because, like you, we all know America is the best and strongest country in the world. That's why their market keeps on going higher every single year after year, right? But um, but the markets are efficient, meaning that it accommodates all types of funny things, interesting things like manipulation. Okay, it's so efficient that they can manipulate prices and do weird things to the market that we can't really catch. We can only strategize around. And at the moment, with $2.5 million selling short the market, it does raise some questions about what's going to happen tomorrow. So we can ask ourselves, okay, well, Rogers Systems, assuming he's managing real money, right? There's always a doubter there. His systems are short Tesla, Netflix, Boeing, Nvidia, and Shopify. So then if you have a bias that's 80% bullish and 20% bearish, then you're probably going to be looking at some contrarian trades in Shopify, Boeing, Tesla, and Nvidia. However, we don't know yet because the markets tomorrow are going to be a little bit, like I said, the fruit punch is going to be spiked because of the two Fed speakers tomorrow. Okay, so we have, that's the things on the watch list. So let's and then for those sell short positions, and with the market, and also with how the market closed today and how the futures are opening, we don't know too much about what we can do other than just wait for the pre-market and just wait for some actual triggers or some setups, like for example the ideal trade setup. Okay, so again, these live focus sessions happen every Sunday and Wednesday, and it's used to reinforce what we want to do so that on going into Thursday and Friday, and then Monday and Tuesday. So that's why I picked Sunday and Wednesday. Now, whatever happens after 10:30 on Tuesday, okay, 10:30 a.m. Eastern time on Tuesday, let me just write that down. Reinforces the trading plan for Monday and Tuesdays. That's for Sunday. And Wednesday's sessions are for Thursday and Friday. Questions, and any questions can be asked. It's supposed to be an interactive. Feel free to ask any questions, okay? This is important to ask questions and not just bend over and tie your shoe without bending at the knee. Just ask some questions, and the answers will come. So whatever happens after Tuesday at 10:30 a.m. Eastern time, that gets tricky. And also 20% of the time, things tend to run higher from Tuesday into Wednesday into Thursday. So just imagine, like, have you ever seen a stock that goes up every single day, Monday, Tuesday, Wednesday, Thursday, Friday? So I have, but it doesn't happen very often. And if we had to put a percentage to it, I would say probably like 5 to 10% of the time it happens. And then especially when you have like 2,000 companies that you're following, I mean, geez, how are you going to track that? So that's the so any time after 10:30, and you might be asking, how did you come up with 10:30 a.m. Eastern time? That is through experience. Okay. And you have to just shut off the system at 10:30 a.m. and then come back somehow magically transport yourself in the future so that you're trading at the open on Thursday. So you don't do anything between Tuesday 10:30 a.m. to Thursday. No, I did not pick up any more Roku at the end of the day. We've got notified that there's 2 Fed speakers speaking tomorrow, so we will monitor those positions and figure out if we need to pick them up, because there's still that gap at the 458 level. Okay, so again, the main point for this focus session is that I really want to get this second campaign. So I've posted the second ledger here, onboarding. That's right here. So campaign number 2. And then if you click on that, you can see that, it's almost like a clean slate, blank, except we opened some positions here. This Microsoft's not working here. Here's why Kathy Wood says it's a mistake to sell stay-at-home winners like Zoom. Kathy Wood. All she has to do is just go on CNBC and hold an eggplant. Okay, so here is the ledger, and it's a clean slate. I don't know how many people took the trade number 1 and 2 on July 9th. So if you did that, then you should definitely, I highly encourage you to use this ledger. It's a brand new spanking ledger. And if you started on July 9th, okay, then you should have this type of record. Okay, we opened up $1,500 using a $10,000 account. Now here I placed an image here on position sizing. So if you can see that, I've provided an additional aid to help you understand what the position sizing should be. So for your account, because that's one of the biggest problems that I have in any Discord or trading room. The net liquid is the hardest part, because it's messed up, because as an owner of this Discord room, I'll share my experience. First of all, there's people who like running a room is fun. However, there's a lot of sacrifices that I have to make, right? I realize I can't do everything by myself, right? And I realize I have to share all my knowledge in order to strengthen the community. And the worst thing is people come in with different net liquids. So that means everything's inconsistent except for the trade alerts, right? The position sizing is going to be the critical part there. So, and why these net liquids are brutal is because you might have somebody with $1,000 account, but somebody with like a $200,000 option account, because maybe they came from an affluent family, makes like a $200,000 profit day, right? And that really messes up with the psychology, and then blows all the timing that we've kind of got accustomed to out of the water. And now we're just looking for the next big home run, right? When you're stepping up to the bat, if you've played softball and baseball, most of the time you're not, most of the players who step up to bat, they're thinking just one thing, home run, right? Especially when you go to the bar, buy some people drinks, and one catches your eye, maybe you want to get a home run too. But it doesn't work like that. You gotta go. I think the RBIs are a lot more important, and then you get one person who's designed, right, to take those home runs, and then once in a while you can take those shots. But it messes up the whole thing when somebody with a bigger account comes in, because we don't know their net liquid, right? And they could say, "Oh, we put in $1,000 and we made 200,000," and that doesn't really happen very often. I think when I was doing some aggressive stuff, I did 10,000 up to 400,000, but yeah, that was during a different period. So anyways, I added this photo here just to kind of help you control the position sizing for the strategy. Okay, so basically when you have a strategy, you can define the number of contracts. You don't pick one. So if you pick one, it's because you're being very, very cautious. You're just testing things out. That's what we do in programming or in engineering. We use a unit value of 1 or 0. Okay, 0 would be just watching, 1 would be just testing, and then using the actual amount would be based on a design criteria. We use Kelly criterion, right? So if you're doing 1 contract or 2, then you are probably trading with caution or light, going into maybe Tuesday after 10:30, maybe into a Wednesday, and maybe even on a Thursday, okay? Depending on what kind of setups you have. But when you have a strategy, right, and you know that you own that strategy, you know exactly how to manage it, especially your risk, timing, profit taking, and all that stuff, then you want to position size accordingly, because the loss is part of the game. So that we have to assume that the loss happens almost all the time, especially when you open a position. Like almost 90% of your positions always draw down, especially when you open up most of them during the day. So you want to position size for a strategy and size it properly, because when you size it properly and just right, then it's optimized. If you size it too much, for example, let's say you have let's say you have a $10,000 account here, and then you pick 10,000, and then all of a sudden you have a feeling you want to put 2 using principal, then you've oversized, right? And that's not optimal, because you have to factor in the losses as well. Okay, if you take a loss on a $2,000 account, your account is 10,000. That loss is pretty big. Okay, especially if you make another $1,000 loss, then you're down 30%. So $1,000 is optimal for 10%, maybe 1,500. We use 1,500, and keep in mind the position sizing here. It goes 1, 2, 3, 4, 5, 10. This position sizing is missing one part: your probability of success, right? How do you know when to use 10? How do you know when to use 5? How do you know when to use 4%? It's based on your probability of success. And once you determine your probability of success, you don't change your position size. Because then if you always use $100, you're never going to get anywhere in life, right? It's like digging a tunnel with a spoon. You're going to be digging for quite a while, right? So you need to, up it up a bit. Maybe bring in a boring machine. So you gotta optimize it so that it fits the job that you're trying to work in, and that's the strategy, right? Now, setups like Wolf Wave setups, that's not really a strategy, okay? Because the one thing that a Wolf Wave misses is the timing. Okay, TGIF has timing. You buy on Friday and you sell on Tuesday. It's that simple. Okay, and anything that appreciates between Thursday, Friday, Monday, and Tuesday is butter. We manage it because that's what we do. We take risk, we manage risk, and if we manage risk, we get rewarded with profits, right? And of course, there's sometimes profits do get a little bit. Holy no way! Netflix is ripping. Ay ay ay. Jeez. Was there a 70-minute TTM squeeze in there? Let's take a quick look. Man. Netflix, it's just one of those stocks that move on No, there's no 78-minute. Nothing. Crazy. What is going on? It's the 4 hour that's triggered cycle 1. Damn, that earnings run. Well, oh well. That would have been a good one. Jeez. Anyways, so when you have your probability of success, like strategy for Netflix, that would be there's an earnings run. That's a strategy because it has a time component to it. So you buy it 14 days or 21 days, and then you just hold it all the way up until the day of the earnings, and then you close it before the earnings is released. So anything with a time component included in the strategy is something that you can use for your position sizing. If it doesn't have a time component, then you really are left to figure out what kind of strategy you're in. And is it a setup or with no time component, right? Which means that you have to figure out what your timing component is based on the allowable drawdown. Or, if you have a strategy and you're drawing down, then you've already managed your risk because you've defined it based on the Kelly criterion principle. So these are all very, very important things to understand. But I've added this photo there just to help everyone out. So once you figure out your position size and your capital, okay, you can, if you, let's say you start off with, I think somebody said they had like $5,000, you wouldn't really use like a $50 1% position size because you can't get anything with that, right? You've got to use something a little bit more, like some of the contracts we pick up on like Roku, they cost $1.50. So if the average contract is going to be around $2 to $3, and you got a $5,000 account, then you got to go 10% or 5%. Okay, you can always know like what's your max, right? So this one only goes up to 10. We suggest 15, right? Because the probability of success is that much higher. I think 10 would be like less than 60%. So if you have a strategy that's over 60%, then you want to use something like 15%. And if you have a strategy that's less than 60%, then you want to use anything lower than 10, 5, 4, 3, 2, 1. And then if you have a strategy that's over 60%, but the markets are a little bit, weird, then you can always reduce the allocation of whatever you prescribed of 15, let's say 15%. You can use anything under that 10, 5, 4, 3, 2, 1. That's a way of managing risk under these circumstances, right? So there's a little bit of a judgment. There's a little bit of management. You're basically a manager of your own risk. And if you don't know ways of managing risk, like let's say there's a Heikin-Ashi candle, you got this nice trend here. Let's take a look at Apple, for example. And so Apple, if we go onto the green Heikin-Ashi candle and you say, okay, I like this Apple, it's long, and the Heikin-Ashi candle is long as well, then you would say, okay, every time I see a green Heikin-Ashi candle, I'm going to pick the maximum allowable position size. Okay, keep notes of this because this is important. Now, if you let's say you're taking a Heikin-Ashi candle like here on a red one into a TGIF, then maybe let's see what happened on that day. So let's say you're right here. Maybe you wouldn't take such a big position, right? Maybe you take half of 15%, like 7%. Let's see what happened there. it kind of like went down a little bit more, and then, if you bought here at the end of the day, it gapped down really hard actually. It's a kicker to the downside, and then it quickly reversed out of that. So then you would have taken a hit, probably 70% hit on that. So you got to understand, like, it doesn't, you can kind of manage risk in that perspective. So understand how to manage risk, because if you don't manage risk, the market will be more than happy to manage it for you. So that's so when you pick your net liquid, when you have a net liquid, and let's say you have like a $100,000 account, and you only want to do TGIF, only, right? Then it means you'll never ever day trade anything else between Tuesday, Wednesday, and Thursday, right? If that's the case, then you would use the full amount of $100,000, and then your position size would be around $15,000 per trade. Now, if you feel that you want to do both, like you want to do feel itchy, you got itchy trades with wolf waves and BLTs with ETs, and you really want to focus on the TGIF TGIT setup, then you would need to divvy up the 100,000 to maybe like 30,000, 30,000, 30,000, and then figure out the allocation for each $30,000 account. That's what you have to do, because it's like a business. I talked about this with other people. If you have 4 friends, and they come to you because you have the cash, you're not going to give just one friend. They all have great ideas. You're not going to give just one friend all the money. You'd probably allocate a certain percentage of that among all 4 of them, and that's what you want to do. Okay, so again, so here it's 15%. That is this is important for you to kind of understand. So you can do, let's say you had $10,000 and you want to do TGIT and some day trades. So maybe day trades, because day trades are setups and they don't have a time component to it. Maybe use like $3,000 out of the 10. And then the 7,000 you'd use for your TGIT, TGIF. Okay, use a 70-30 distribution. And the reason why we use 70% for the TGIT is because we know that it works more often than not, right? Because it has a higher probability. Why do we use 30%? Because the 30% is using not a strategy, it's using a setup that we use here a lot. That's like the BLT, ET, Wolf Wave, all those other things. Just one second. All right, so let's move on. Jeez, that Netflix just ripped up. That would have been a great 10 seconds into the close trade, that's for sure. All you had to do is just wait till the very end of the day. But then the question is, how would we have known that it would have been Netflix, right? Other than just knowing its earnings. Okay, so let's go back to the focus session here. So we've pretty much removed all of these. So we are going to assume 0 profit, right? But we want to also keep in mind that this is the maximum allowable drawdown. So as a manager, you want to always try to keep the drawdowns to the maximum limit. Sometimes you'll find yourself in a position where you can't, because it already drew down so much in the first hour of the day, and usually you want to wait till the very end of the day where all the data comes in from the markets to see where it stands. But even if it draws down more than 50, 60, 70, even to 0, that's the whole point of having Kelly there, because Kelly will be able to help manage that risk for you in a invisible hand way. Because if you didn't know what your position size was, then I guess the optimal position size, then I guess you would probably be either doing 2 things. You'd be too conservative where you just have one contract, or too aggressive when you over traded. So you need to find that right sweet spot, and that's based on that 15%. Okay. So that's that, and we'll just go to this ledger right here, and we'll just copy paste this, and then say as of July 14th, right? So we started July 9th, and it's pretty much a clean slate, assuming $10,000, and then I'll probably just, let's see if I can copy paste that position size. And you want to kind of keep in mind your position sizing, so that in the case where the 50% drawdown gets out of control, then you have Kelly there to manage it for you, to all the way pretty much to zero. And the question is, sometimes I get the question, do we let them go to zero? Like, in theory, yeah, you should. In theory, you should always let your positions go to zero. But most of the time, there is significant equity performance if you are able to manage the drawdowns within a certain limit, like 50%. Your equity curve moves a little faster. So it's like almost like the same thing as trading. If you get into a trade, we're obviously assuming 100% guarantee. We're assuming that it's going to work for us, and we're going to make lots of money on that trade. But so we take the trade, right? We put in risk and we take the trade. And if it doesn't work, right, then what happens is psychologically we have that hope, and then we would still insist that it's going to work out, even though that the DK is killing those contracts. So when you get blinded by hope, then you're still in that assumption of thinking that it's going to turn around and break even. And that's why Kelly is there, so it helps you from making from blowing up your account. Now, if you think about in the opposite, if you think about an opposite, where you are trying to guarantee 100% that it will continue to draw down under 50%, that's the same thing as assuming that your trade is going to make 100%, right? And that is managing. So if you can guarantee that when you close the position at a specific time and day of the day at 50%, you have to be very, very, very sure that it's going to be going down even more, which most of the time it does, but you got to be really sure, because if you close it and it starts ripping back up higher, then that's going to really suck, right? And Kelly is already there assuming that you're going to take a 100% loss. So you got to it's almost like when you close that position with a drawdown, it's almost like trading long directional calls. You have to be 100% sure that it's 50%. It's going to go lower than 50%. So that's what the maximum allowable drawdown is. That's what you need to kind of remember. And the maximum allowable drawdown implies that you have to be 100% sure that it is going to continue moving in the opposite direction. Otherwise, if you close it at like I've seen positions go down 80% drawdown and then go up 2,000%. So these things, in theory, we should really never close any positions that we open. But if we know with a high degree of certainty that closing them off is better than holding, then you have to know that, and that will help improve your performance. So taking a look at the equity curve here, when we got into positions on April 29th and May 17th, we were drawing down 86%. So if I was able to reduce the drawdown from 86% to maybe half, I would be up maybe a little bit more than $400 or $500 extra in my account. That would be huge because that would be definitely near $10,000. That's 100% over 30 trades. Okay, so 30 trades is not a lot, and that's that's not a lot of trades. All right, so so then I'm going to replace this and strategy. So campaign number 2. And it's a brand new spreadsheet. And yeah, if you're if you're serious about trading, you should, I highly recommend using this ledger, okay, because it helps like keep things like the housework organized, right? So you gotta be able to clearly understand, why you're getting into it. What's the contract price? What have you been doing in the past? What does it look like now? What's the record performance look like? And it's important. Like if you don't do it, then it's kind of how do you say, it's not, you're not being a responsible trader. So you should try to practice. It's kind of like doing your bed. Does anybody make their bed anymore, or have a habit? So it's a good habit. It's one of these good habits. You have bad habits and good habits. This is a good habit. Focal point, yes. And yeah, making your bed is a very, very it's a habit, right? Some people do it, some people don't. Yeah, I got a question. So the this ledger here, I'm spiraling down 40%. So that's a very interesting statement. Spiraling down 40%. So do I stop following your trades? Well, that's up to you. I follow high growth. So I'm not quite sure what the question. So do I stop? So I think you're. Do you have let's start off with. Let's do this. You can see my screen here. So you took Tesla, Roku, Microsoft. Right. So over trading. Right. So with the TGIF and TGIT, if you're on board, I think you're relatively new. And I'm not sure exactly what the position size for all of that were. But I strongly think that if you're going to try to make a lot in this market, you've got to financially plan your trades in an organized manner. And yeah, I may have taken Tesla, Roku, and Boeing, and I'm not sure about Microsoft. But the question is, if those are the setups, then how did you position size? And if you're onboarding, I highly recommend you to force yourself to double your account through the onboarding. And then once you double your account, you have house money. And then you can use that house money to take trades from bags once you understand, a little bit of the ideal trade setup. Now, I don't think 40% is a very general percentage. So is that a percentage of the total net liquid, or is that a percentage of the partial? The total net. Yeah. So what was your total net? Tapesh is asking, just to confirm, your specific onboarding alerts aside from others will be in the trade alerts. Yeah. So Like I discussed before, onboarding is specifically sized allocation. So you know exactly what the maximum number of contracts you should be picking up, which is 50. Well, I don't know. Like based on a $10,000 net liquid, it should be $1,500. But when you see some of my trades in the trade alert, where we write down like a percentage, I write down a percentage because I don't know exactly what anyone's net liquid is. It's hard for me to. There's like more than 100 people here, and everybody will have a different net liquid. And position sizing is a tricky topic because the higher the net liquid, the lower the position size is, right? And so for example, when you take a look at the screen, when you have a big net liquid, right? A $2,500 position size is 1%, but a 15% or 10% position size for a $20,000 account is 2,000, right? Because see how like inversely related that is, and that's why we put percentage, because we don't know, and that's why it gets a little bit complicated. So I think it's so with the trade alerts, if you take the trade alerts and it has a percentage, that means it's a setup, and then you should look at that setup and take it based on the description. If you don't understand the setup while I'm in it, then don't take it, right? Because you gotta have at least, in order to succeed in trading, you have to at least have a setup, and you have to have a strategy, and you need to manage risk. I think those are the three things that you need, and then stay healthy, because you don't want to choke. So basically, yeah, on the onboarding, when I type in onboarding, then you know exactly what the allocation amount is. Okay, it cannot be one contract, because why would you buy one contract for a strategy that has a 60%, 65% probability of success? So then that means you're not optimized. It means you're not following the trading plan. If you buy one contract for a setup, then I can understand why you did that, because you don't have a timing component involved. You're just going to take profits when you see it, right? And that's the biggest difference. So you can't put in, when somebody puts out a trade alert, right? When I take a look at some of the trade alerts in the active channel, I'm always thinking, what the hell? Like, how big is their account, right? I don't know. I can clearly tell. Like, I've been doing this risk managing thing for so long. I look at it as like, how big is their account? And when I see other people's accounts, I'm like, you have to know, like, I'm managing like 60 accounts here in the background. They're all different. No one has the same net liquid. It's very rare to see one account be exact mirror images of the other. Nobody started on the same time. Nobody started on the same date. Some people started with the same net liquid, but they started with the same different time. Every single account is different. Okay. So, yeah, like, so you gotta, the trade alerts are discretionary, which means that they don't have a time-based component involved. Therefore, the position sizing is should be much more conservative, unless you have the ideal setup in play. If you have the ideal setup with an A6, Hikinashi candles green, nice tight, maybe a short squeeze with a purple D, and then you got the target with a gap fill, then maybe you can start upping your position sizing because you have something that fits your criteria. But if people are randomly, it feels like they're randomly generating alerts based on their setups, right? Then the main question is, how big is the position size? And how big do you want to take it on something where we don't have a timing component? So do you ever go into a trading room, Like with TGIF and TGIT, do you know how much of a luxury it is to know that you are holding the position from Thursday into Tuesday? So you open up the position and it's drawing down, and it's drawing down, and you're like, okay, well, it's only 40%, 30% with position size. It's okay, no problem. We'll see what happens on Friday. Market internals looks good. We got power hour rally, recovers up from 40% drawdown to 30%. Over the weekend, boom, you're up 200%, right? That's such a luxury to have. But when you take a trade alert based on a setup, do you know when to close a position other than when you make double or whatever your profit is? So the timing part is critical. If you don't have timing in there, then you're just literally trading a setup. If you're trading a setup with timing, that's called like a strategy, then you have a better feel for what you're getting yourself involved in, which means that you have everything a little bit more calculated, such as your position size. And that has to be optimized. If you don't optimize your position size, you're not going to grow your account. It's going to get too choppy. If you take trade alerts that are based on setups, then you have to know that those setups have no timing involved. So we're making estimates of when we are looking to close the position based on either profit or if we get a rip. Like, remember that square? I bought the square and all of a sudden it just ripped up like all of a sudden. I didn't know that, right? So these are the things that we have to really understand. And for all the onboarders, I came on in the morning just kind of reiterating that you got to focus on doubling the account first. Once you double your account, then you can start going and taking bigger trades on discretionary trades, looking for the ideal trade setup and making some big home runs. Okay, this is very, very important to understand, and we'll keep on repeating this during the focus session. All right, so then going to the next here, this is the TGIT TGIF trading plan moving forward. So 2 weeks ago we started off with Tesla with $800, and all of a sudden we found ourselves up to almost like 3,600. Yes, we should have taken profits at 3,600, but then we got it up to about 1,600. But the main point is not the amount of money we made on those first two trades, because those trades actually happened on a Wednesday. The most important part is how many consecutive winning trades can we pull out of this strategy moving forward. Now, is it going to be Tesla? Is it going to be Roku? Is it going to be Netflix? Which ticker is it going to be? We're still trying to figure it out, because Roku is already done to death. It looks like it's kind of going to consolidate. Holy cow, Netflix keeps on moving higher. Jeez. But yeah, we want to make sure that we find the next TGIT TGIF. It could be Netflix, okay? It could be Tesla. It could be Roku again. We have to watch it. And I think last week Tesla did move up on Monday, and we will see if we find find another opportunity on Friday with Tesla. But Tesla has definitely pulled back quite a bit from 670. I think it almost reached up to 700, and then it pulled back to 654. And we'll be keeping an eye on that this Friday. So the main plan here moving forward is the whole idea, I know most people will probably not remember this, but if you're serious about growing the account, there's lots of time to make a lot of money in the markets. But if you're trying to grow the account, you want to start off with the seed money. So $800, which we kind of did today. A little early entry on Roku when I was trading above the 6. And it didn't work, right? So we write that in the ledger, another loss, and we wait again. Okay, now we wait for the official trigger and see what kind of setup we get there. And then after we start to realize that this thing is starting to work and it's working every week, right? Then we start to think about the number of consecutive wins we can pull out of this trade, out of the strategy. and that could be around between 7 to 6 to 9. So that's the goal, is to catch one of these consecutive winning streaks, which we'll talk about today. And here's Elon Musk, and these are the consecutive losses that you can go through, and these are very, very big losses, right? But you can also see in the number of trades here from 523 to 533, the 10 trades here, you would have had about 1, 2, 3, 4. Well, you had a winning streak here, 1, 2, 3, 4, with 2, 7, 2, 4, and 8% return profits on that trade on a TGIF. And that would have been like, if you started off with $800, that would have been almost, you would definitely gone up to about 8,000 at 3.99 on trade 526, and then you would have lost a good chunk on 527. So that depends on what kind of setups, how the setup was forming on that Friday. And then you would have made a lot more on 528. So I would say from $800 to 7,000 drops to 4,000 goes up to maybe 7 to 8,000 on that 8% win, maybe 6,000. So you might be up to 6,000 right here. And then you got a series of losses here. And I would assume the Heikin Ashi candle was red going into these from 529 to 532. Okay. And if you're able to identify that, then as a manager, you would definitely relax on the risk, right? You don't want to be putting in, when you get your first loss, right, and the Heikin Ashi candle is turning pretty ugly, then yeah, you probably don't want to be putting in too much. You don't want to be putting in the maximum allowable. Okay, so that's the plan here. So again, the focus session is we're trying to look for the next TGIF, TGIT plan, so we can find these consecutive wins. When I look at Netflix, obviously I'm itchy and I want to trade Netflix, but Netflix is way extended. Like, we'll take a look at Netflix right now. You can see Netflix after hours. Look how high that is. So it's already on cycle 1 on the 4 hours. So another 8 more hours is in cycle 3, and I'll probably just like trade flat at the open. But it's actually going to look like it's going to try to take out that 600 on the daily. It's already up at 564 right here, gapped up. So that's not good. That's because it can actually fill the gap, which it won't. I don't think it's going to fill a gap as it runs into earnings. But yeah, pretty crazy move, man. Jeez. All right, so we got a question from Tepesh. Okay, so total net. So your total net is 40% drawdown. I still think so. What was your total net in terms of the dollar amount? Let's say I bought 2 contracts according to my position size parameters. Now I notice that the stock is ripping like crazy, like Amazon crazy. I would want to buy more contracts, let's say 2 more, but violates the position size. So then why would I would want to buy more contracts, let's say 2 more, but violates? Yeah. So did you so basically the answer to that question is the setup. So let's say you bought 2 contracts according to my position size parameters. So your position size parameters can actually increase and decrease based on the probability of success. And your probability of success is determined by the actual setup or strategy that you're working with. So you need to, before you buy those 2 contracts, okay, you have to figure out whether it's a setup and what kind of setup it is, or if it's a strategy. If it's a strategy, then it's not going to be 2 contracts, right? Assuming you have, let's say if we go back to this matrix here, if you have a strategy, then and it's over 65%, then and you have a capital of 2,000, then you're using $200 for sure. There's no doubt about it. Okay, and so then let's say you had $10,000 and you have a strategy that's 60%, then you're using $1,000 at least. Okay, that's for sure. So then that would remove half of the question. Now the other half of the question is where you're saying you have you would want to buy more contracts because it's ripping up crazy. Now so if you have so then you would have to figure out the setup, and based on your setup you have to figure out the number of contracts that you are willing to pick up, which could be up to the maximum allowable limit of something that's 64%. Now, 64% is hard to identify if you're trading on momentum, because the way that you're phrasing that question sounds like a momentum trade. So you want to buy two and then not manage any risk and wait for the pullback and then buy an additional two. And you would have to be very good at watching momentum. So learning those cycles, cycle 1, 2, 3, 4 rules while you're managing your profit and your risk. Other professional traders, what they do is they actually open up 2 times their position at the beginning of any trade, especially trades that are set up. And they would scale out of those positions as profits start to come into the trade, into their positions. So that's what you would need to do if you were to find Amazon ripping up like crazy. You would have to first identify the setup, and then based on the setup, you'd have to figure out if this setup is an ideal setup. And then when you identified the ideal setup, then you would have to figure out what the probability of success that you want to associate that setup you found with a percentage. And if you do that, then you won't have to worry about just buying 2 contracts. Because if you're buying 2 contracts, based on your position sizing, right, then you know the probability of success. And based on your sentence, it sounds like it was 50-50. So that's why you bought 2, maybe 55%. But let's just assume hindsight analysis, and you knew that it was going to rip up and there's a potential, and then you knew that if you get into it now, you're going to get 600% return. So then you would think about it. How much would you have put in? And obviously the answer would be like everything, right? So you can't do that. You can't think like that, obviously, because we don't know. We can't predict the move in advance, right? We can kind of anticipate the momentum, which is always going to be 50-50, but it's the setup and the allowable and then the risk that you're willing to take on it, which is defined by your Kelly criterion, is what you need to figure out when you find that setup. So if you're doing just a day trade and it's a setup that's mediocre, and then you would just put in 1 or 2 contracts, and then you're following your minimum position size parameters. So the minimum position size parameter, based on something that you feel like you don't know what you're looking at, you're just hoping, like you're hoping parameters, then it'd be 1 or 2 contracts. But if you have an ideal set of a setup, right, then you should have ideal position size parameters, which would be not 2 contracts. It would be probably 4. right? So then you got to say, okay, when I get 4 contracts, does that setup look like something I would want to buy with 4 contracts, and then scale out? And then when you scale out on 100%, so that the remaining 2 is free, then you can kind of wait till the end of the day, look at the trend, look at the market internals to see if it's, and watch the VIX and see if that can help you stay in the trade for those last 2 contracts. And that's basically what you need to do. So I guess the idea here is your position sizing parameters have to be defined clear in your head. If it's a position size parameter that's defined as the minimum amount, which you have no idea what kind of setup you're doing, then you would do 1 or 2 contracts. If it's something that has the right look, you got the yellow D, A6, 70 minute, BLT, ET, whatever, then you would do 4 contracts. Okay, and then once you do that, the risk is there, as if you're setting up a business. Let everybody create that business and let it run for a little bit. Maybe every 30 minutes you can check up on it, and then manage those profits, especially at 100%, half, right? Half is no brainer. Look at the report of the business, like the trend, the VIX, to see if it's worth holding the rest into the close, and then come back at the end of the day and see what you have. And that's pretty much what you need to do. So I hope that helps. Another question, and Roger, you nailed it. It's that's what us newbies don't know. We pour more money. I pour. Yeah. So so this TGIF has been working for a very, very long time. It works. I know it works, but it's the way that you manage your risk is something that has to work. Okay. So if you do the day trading stuff, then it's okay to day trade 1 or 2 contracts here and there, assuming they're not like Amazon type contracts where like 1 contract's like $3,000. But the main idea is that if you day trading and you don't know like the position sizing amount, then you gotta probably just stick with 1 contract. Okay. If you have a strategy, which I'm always talking about here, the TGIT, and we know the probability of success, then you know exactly how many contracts you get. So the only question is, did you get the full amount of contracts or did you get less? And if you got less, then that's not a problem. Okay, because it could be the first trade of a consecutive 9 winning trades, right? It doesn't matter. Well, actually, it does. Well, it will matter if that first trade is like 10,000%. But if it's just a normal strategy that has a certain return on your investment, then it doesn't really matter how much money you make on the first trade. You just got to make sure that it's compounding every time you do that TGIF. And that's the most important part. So yeah, I guess there's always an exception, right? So if you get into a TGIF and your first trade and you only put in like 1%, and everybody put in like 10%, and then all of a sudden the company gets bought out and you're up like hundreds of thousands of dollars, but the other person's only up 5, it does make a difference, right? Obviously, but those are very, very rare instances. I don't think it would fit in the model of a 60% win. That would be like a 1% win. It happens probably 1% of the time, like Stamp. So imagine if we had Stamp going into a TGIT. That would have been crazy, and it had the ideal trade setup. So as we go into the, so this is what we did on Tesla on Wednesday, and then I proceeded to kind of use a theoretical compounding of full profits. That's 100% of the profits was used for trade number 2. 100% of the profits were put into trade number 3. Obviously, this is theoretical. We wouldn't really use 100% of our profits. You would still have to manage that risk. So when I say risk, you got to manage that money. So if you make 100% if you make 100% on something, then you should probably take half out and then use the other half and reinvest it. Okay, and so forth. So you would continue to do that over and over, and then this is how your account would grow based on the compounding method. And these are only 9 trades, right? So some people probably made 9 trades today and are not anywhere close to this. And this is 9 trades in 9 weeks, or maybe less. So you should understand that the compounding effects of a strategy is the creme de la creme of options. So if you're able to get into a trade that makes consecutive wins over and over and over again, then you've got a very, very good shot of making a lot of money. But if you go to a setup, then it's a different beast. You're looking to capture on the big breakout, kind of like what Netflix is doing right now. But Netflix had no setup. It only had an earnings run. So that one was a little bit tricky. Okay, so we were at Tesla here, and then we were up as high as 3,600, and then we dropped down to 1,600. Did anybody get into this Tesla trade here? If you did you close off over 3,000, or did you close at 2,000? I don't. Some people were probably in it or probably not in it. Just our first trade, we were almost up at like 3,000, 3,400. That was back a while ago in June 20th, I believe. All right, so this is so yeah, if you just joined, it's important to understand that the mindset when it's like just like anytime when you have money, then you're more free to go around and spend, right? But as you're beginning the campaign of your first onboarding, you've got to master the discipline part by following the TGIF and TGIT. You can take some early trades, right, to kind of make it feel like it's a day trade and you want to get yourself involved, but anticipating the strategy with the setup. But you got to, if you like I mentioned in the video, if you follow the TGIF and TGIT and you are an expert of the ideal trade setup, you will be the best trader in the world. I'm pretty sure about it. Okay? And then if you remove all the noise outside of the all the other trade alerts, right, and just strictly focus on this strategy, then you will become the best trader and you will make a lot of money. Okay, but you gotta figure out how to not overtrade, because overtrading can be as easy as making 3 trades, right? Because your position sizing could be 4%, and then you put another 4%, and another 4%, and you're at 16 or 12 all of a sudden. And that's a lot. So the position sizing is so important with the timing of the strategy. If you do this and you do it well, you're consistent. You catch one of these compounding plays, because that's the only way you can make a lot of money in options, like with a high probability of success. Because imagine like the Stamp. I don't even follow Stamp, but it made like a 60% move on Friday. But how would we have? I follow 40 tickers. So 1 out of 43 is not a very high probability of catching a 60% winner, right? So you gotta, if that's the case, then you gotta find like a strategy with the prescribed parameters in order to make this thing happen. And then with the TGIF and TGI2, or any rule in general for the golden rule, you gotta look for those maximum profits on that trade play, right? Like I mentioned before with the 50% win, you gotta make sure that you are the 50% maximum allowable drawdown. You have to be sure that that's a drawdown that you're willing to close. And you don't have to worry if it draws down even more, because if you position sized properly, you can take one or two big hits where it drops down to 80%, and you'll still be able to make money a lot. It's just not over trading. I think over trading would be the main culprit of why people blow up their accounts. So if you get into a drawdown and you're drawing down like I am, then usually you just want to just stop and then wait for the next trading setup and see how it develops on Thursday or Friday. If it's not there, we don't take it. If it's there, we take it. So the idea here is step one, like, of course, we all take risk, and when we manage risk, we make profits or, manage our drawdowns. But you want to open up at least 2 or 3 contracts based on what you're trading. So is it a setup? Is it a strategy? Right? Is 2 contracts the optimal amount? Right? So if you get into a trade and you don't know what the probability of success is, then your position sizing should be probably set to the absolute minimum, which would be 1. Okay, testing out the water. If you have a setup and a strategy, then you need to optimize the position sizing such that it reflects what the probability of success is. And if you don't do that, then what happens is, if you get into a strategy with a 64% probability and you only get in 1 contract, where you should have gotten into like 5, and then it rips up higher the next day by 200%. So then now you feel like you want to do it again, but this time with the right position sizing, and then you lose 50%, whereas the other person would have just lost 50%, half of their profits from yesterday, from the last trade. You're at a huge disadvantage, right? So you try to be consistent so that the numbers start to kind of average out the losers with the winners. If you start fiddling around with your position sizing, saying, this is 64%, I don't like the setup, and you're using feelings rather than using the strategy, then you might be taking smaller trades unnecessarily. And then, then you might, if somebody makes a 400% win on the first trade, and then the next trade they put in this a reduced position size, that can work, right? Or stay consistent, that works as well. But if somebody starts off with the small amount and loses, then the next trade that they take should be the same small amount. And then if they win on that one, then they would add a little bit of profits from that win to the third trade and see if that compounds. And if that happens, then you keep on doing that over and over again. But make sure not to use the theoretical profits, right? All right, so let's go to the trading plan for July 15th into 16th. So the futures are flat. The calendar is 51% bullish. So you can it's 51%. And especially after today, probably it ups the percentage from 51 to a little bit higher than 51. Okay. And then Trin on Monday was greater than 2.3 on Monday. So we are still expecting everyone is the best trader in the world day, and that obviously can happen either on a Thursday or Friday, We have two Feds speaking. Oops. We got two Feds speaking tomorrow. So that's Jay Powell and Fed President speaking at 9:30 a.m. Eastern time, and the president speaking at 11 a.m. Eastern time. So this is pump or dump. Case 1. Case 2. Dump or pump. Dump, pump, and dump, or dump and pump. Hope that makes sense. So what that means is that when Jay Powell starts speaking, the market will dump, and then it'll cause a frenzy where all the tickers are selling off within the first 1 to 2 hours of the day, all the way up until 11 a.m. And then from 11 a.m., the other Fed will come in and speak, and the markets will start to rally. And that could happen tomorrow, because there's two Feds. Okay, the other case number one, they pump it. So Netflix is showing some pump, which could obviously help the market, give some clues about it moving higher. And Jay Powell could push the markets higher with whatever comments come out of his mouth. And then at 11 a.m., the market proceeds to dump into the close. So these are the two things that you have to be cognizant of. Currently, the long positions in the system is Apple, Netflix, and Google. Those are the long positions. And the sell short positions are Shop, Tesla, and Nvidia. Right? Oh, and Boeing. Thanks. Jeez, that Netflix really added an extra $1,000 to a lot of people's accounts all of a sudden. It's kind of crazy. So that's and we're evaluation of July 14th markets. All right, so the open positions we have is just Roku, and I do have Netflix one contract left. Okay, so as you can see here, I do have these contracts left. I did not close them. So I don't know if anybody has, and I have one contract of Disney. I have two contracts of BKNG, and I have 10 contracts, which is also part of the onboarding. Of the $500 calls, which we opened up twice, one at 85 cents and then closed it, and then one at 65 cents. Okay, and then miscellaneous. I closed off the Las Vegas Sands and Chewy. Those are not my alerts. Those are just trades that I took from the active. Okay. So the plan here is I did open up Square, but I closed it. And I did open up some other positions, but I closed it. So these are the only positions that I have as of now. And I am drawing down in Roku. And I'll probably be up quite a bit on my Netflix, probably about $14. So that should be a big win. So the trading plan for Roku hold Roku 500 calls and wait for the first 30-minute candle to form. And why do we wait for the first 30-minute candle? Because the usually TGITs trigger at the open. So in order for it to trigger at the open, the first 30-minute candle has to rip higher. And just to be a little bit specific on how TGIT works, is that I'll show you here on the screen. So if you go to TradingView, I type in not TGIT, Roku, right? Roku works on the 30-minute time frame with the extended hours turned off. So how does TGIT trigger on Roku? So first you got to go to the 30-minute time frame and then add a specific moving average, which we back tested. Okay, every single ticker will have a different moving average when it triggers a TGIT, TGIF. For Roku, it's the 60 moving average. So you just type in moving average and you click on this one, and then it adds a moving average here, and then you just set the parameters to 60. And you can see that now you can see the where Roku needs to move in order for it to trigger. Okay, so does that make sense? So in order for Roku's TGIT to trigger, it has to move above this 426 within the first 30 minutes and get above there. And once it's above there, the second candle, which will be the TGIT trigger, as long as it opens above the close of the first 30-minute candle, TGIT will trigger. So I don't know if anybody understood that. So let's just do it in a very simplistic fashion here. If tomorrow, so that's why we wait for the first 30-minute candle. So hold Roku and wait for the first 30-minute candle to form in the morning. So that means we're anticipating a big candle like this. That's the first 30-minute candle. Yeah, this is the plan for Roku tomorrow. And then the second 30-minute candle will have to open above the first 30-minute candle in order for the TGIT to trigger. If it opens below, like here, it will trigger as well. So it has to open above, it has to open above the close. So it won't trigger there, it'll probably trigger right here. And it has to be above the 6426.66. So TGIT triggers for Roku at 4:26. So kitty. Well, so that's the main idea there for Roku. So BKNG is not working, so this is invalid. Disney contract, hold into earnings. These are free. And then Netflix, if you have them, right, which I do, close tomorrow at the open. Oops. Okay, so that's the plan. And the whole idea of this is just to kind of figure out whether we are going to see the Roku run up to 458. When we take a look at Roku right now on the daily, the issue here with Roku is that it's got a pretty nasty looking red candle here. So in order for it to trigger that TGIT, then the next candle has to open up inside or rip up, open like at the close today, and then push above 426 by the within the first 30 minutes. Otherwise, we'll have to probably we'll probably have to close it out and look for a TGIF. So we'll be flip-flopping back and forth between TGIF and TGIT, but we want to make sure that if we do, we want to make sure we wait for the first 30 minutes to see if it rips up and triggers that TGIT on Roku. All right, so that's Roku. So let's take a look at some other tickers that has a potential TGIF or TGIT compounding type of trade setup for the onboarders and for also the active trade alerts. So we'll look at Tesla. So the reason why we're looking at Tesla is because last week it did the BLT and it actually did very well on that TGIF. So you can see here that was about maybe 150% profits on that TGIF. So that's a good sign that Tesla might repeat again. But you can see that we need to, like, this is very important here. You probably want to take some notes. So we were like, it's either we take Tesla or Roku, right? We don't want to over trade. And we made a little bit on Roku. I remember what happened on Monday. They were both ripping up like 2-3%, but then Tesla kept on pushing off that 78-minute. Both of them had a 78-minute TTM squeeze. So we can see it on both screens here. If I put it here on the right-hand side, and then I duplicate this, put it on the left-hand side, put on Roku on the 30-minute. Jeez. So you can see here, Roku triggered TGIT. This one is, I think this is July 12th, and this is July 9th. Oh, this is extended hours. So July 12th. Let me just double check this. July 12th is Monday. Oh, 9th. That's Friday. And then this one, yeah, so there's something wrong with this Roku one because I think we got in on the, well, it's just, I can't remember. Yeah, this one, we need to double check this code for Roku, but this was the 12th. So we got into Roku on the 9th or the, well, let's take a look at the ledger. Yeah, we got into the 9th. So close at 3 and 2. And that's probably on that candle right there on the 12th, right? 9th, we opened up on the 9th. Okay, so there's missing, that's the yeah, we had the 480 calls as well. I'll have to take a look. This is kind of confusing me. But you can see here that there's Darvas channels forming. And then on the 70-minute time frame, we had that guy right there with an interesting looking purple D. On Roku, we had a 70-minute TT and squeeze setup as well here, right? So it was all just based on, and then it had the purple D there too. You can see they're almost identical, right? And they, like, the charts all look pretty much the same. I guess it had you picked up Roku right here, you probably could have made some decent money. Tesla like, or same thing goes for Tesla, but yeah, you can, it's just I think we went for Roku because we have that target there, 458, whereas Tesla, we don't have a target, right? We just know that it's going to trigger, and we're expected to hold it to till Tuesday, but manage profits along the way. So this is an interesting case between Roku and Tesla. They look identical on the chart, but only one moved up 4.5% on Monday, whereas Roku only moved up 2.2%. And I think I saw the $500 calls go up to, was anybody in those trades with me, the $500 calls? I think I have to put that in the yeah, I think they went up as high as $5. I can't remember. Was anybody in that trade? I can't remember. There's so many trades. Anybody have a good memory here? Nobody? Yeah, so I guess nobody was trading that. But that was, you can see that they're both identical, and no matter what kind of technical analysis you use, it's not going to help you really to identify the magnitude of the move. And I think the only thing that will help you identify the magnitude of the move is the wolf wave. Okay. And I don't know if there's a wolf wave in Tesla on that day, but we chose Roku because we had magnitude defined with the gap at 458. It just didn't move. And I guess a little bit of news does help with moving the price. I think Tesla had some news over the weekend about some sort of, I don't know. But it was clear. It was clear. And we even talked about getting into Tesla, right? We had the poll. I don't know if anybody remembered the poll. But let me see if I can just post it here. It was off of the BLT trigger TGIF. So you have to ask yourself, like, maybe we could have done 50-50, right? Like, we could have used 5 contracts. So we know that the maximum allowable TGIF or TGIT is 15% using a $10,000 account. If you have a smaller account, you probably have to use 20 to fit with a 15 or whatever. And then you can split those, you can divvy up the 15%. So you put 7.5% in Roku and 7.5% in Tesla. Okay, you can do that too. But we were just being, in our case, we were just being consistent with the plan, because most of the time we've been trading Roku quite well, most people, but on Monday, obviously Roku didn't move up 4% like Tesla did. So these are some things that you can consider when you have you can clearly see they're both identical setups, just one moved up. So it was on this candle right here that it failed. It should have kept on moving higher, but in this one it kept on moving higher, right? So that was the issue. Nothing you can do about that. Okay, so going back to the trading plan. So again, July, we are here. And so we are here. Tomorrow. And the 6th and the 7th, I don't know exactly what kind of day. Do you think the day was bullish or bearish? Did you think today's day was bullish or bearish? To me, it was pretty bearish, but based on the index, it still closed green. So technically it was bullish. Lots of blood, but the S&P and the Nasdaq was still green. Yeah. So we have to remember that Wednesdays are like this, and we got to trade a little bit cautiously, especially when the Fed comes in. And I hope in the future, I'll always remind people about this day, because actually this day is actually very unique. I haven't seen a day like this in a while. But hopefully I can remind people that, these Wednesdays are like trader days, Sabbath, and we should kind of control our risk. Actually, we are here. And these 2 days were bearish, I think. I can't remember. So we're here tomorrow. And you can see that we have bullish expectations, but there's a Fed in there on Thursday, so got to be careful with that one. Let's check if there's a 70-minute TTM squeeze forming in the futures. Yes, there is. So the S&P and the Nasdaq are scanning. And you can actually see a ideal trade setup on the Nasdaq right here, with a bearish wolf wave on the 78-minute, but you can see that it's within the yellow Darvas channel. That implies that it's technically setting up for an ideal trade setup. So you got the TTM squeeze. So this is a very good setup to talk about. And you would say, okay, well, like there's a bearish wolf wave, and that's a setup for the downside. And the Darvas channel is being displayed in such a manner that where price is contained within a range. We have a 70-minute TTM squeeze here that is setting up. So what does that mean in terms of our probability of success? It means 50-50, right? So then now with this setup in mind, you have to figure out what is the the risk that you're willing to take to see if this TTM squeeze triggers and breaks out above 14,996. So because of the timing of the Fed coming in tomorrow, it is a bit, the risk of these Feds creating a lot of uncertainty with just like the volatility will increase based on what they say on Thursday, and then one will feed off of each other. So in my opinion, based on my experience of trading around Feds, it's not that great. So taking risk on this setup going into Thursday with the Fed in keeping the Fed in mind is I would say unnecessary risk. Okay, if you're trading futures, or if you're trading futures, then I mean it's a different thing, different beast. But if you're looking for a breakout, you have to put on your thinking cap and say, do you want to trade in that market when when those two Feds are speaking? And as you can see, it's trading above the 6-day moving average. That's these green dots. So the trend is still intact, and I don't think the market is going to pull back unless it starts closing under that 6. So far, it's still trading above it. So we have to assume the path of least resistance is moving higher. And then you can see technically it made a new 52-week high here this morning, and then it made a 52-week high back here. So it's making higher highs, which is indicative of, which is most likely pointing to making another 52-week high every single second day or third day. But if Jay Powell does something nasty, which we don't know, then what will happen is we get the market shoot down all the way down to the 21-day moving average really fast, like right down here. So there could be a potential drop in the S&P and the Nasdaq maybe 1.5 to 2%, and that could follow through into Friday. And that all depends on what the Fed does. So it's not clear exactly which direction it's going to go with a high degree of confidence. And on top of that, the Fed also has the ability to make the market just do nothing. So because of the Fed's ability to pump, dump, or chop the markets, that's a 33% chance of getting one of those right. You have to really think about your position sizing with extra care. Let's assume there was no Fed speaking tomorrow. And everything is trending. So we resort to the original bias of being 80% bullish and 20% bearish, and things become a lot easier, right? Because we don't have to worry about the market being induced by Fed garbage, right? The Fed is going to say some things about whatever they want to say. The algorithms will be picking up each word and then using it for whatever it wants to do with the markets. And we cannot predict that. We can only trade around it. So I would say tomorrow is again, another example of what we should have done on Wednesday. My risk was well contained. I was just using some of my profits. I hate to give back profits, but today was Fed. Tomorrow is Fed. And there's case 1 and case 2 where we can see pump and dump, or dump and pump, because there's two Feds. And we don't know which case it's going to be. And even worse, it could be one of these days where everything is dumping except for Apple. Okay. And it looks like Netflix is moving higher. So these are very, very tough. It's a tough market. It's going to be a tough market tomorrow because of the two Feds. And I would be very, very careful with the position sizing. Extremely, if your conservative position size is just 1 or 2 contracts, limited to $200 for a $4,000 account, I would probably drop it down to 1 contract and just wait for the Fed to get out of the market and then come back in on Friday. That's what I would do. Okay, so that is the idea for the futures. The futures is setting up for a yellow D breakout of about 14,996. If Jay Powell says anything nice, then we see the pump, and then at 11 a.m. The Fed president will come in and dump. If the opposite is true, then Jay Powell says something weird, and the market dumps all the way down to the halfway to the 21-day moving average, and then the other Fed will come in and then pump the market. This is what we need to be careful of going into Thursday. And after Thursday, once the Fed is out, we're back to running higher, I believe, because we have a target in the S&P all the way up until 5,000 by year end, hopefully. Let's take a look at the year-to-date performance on the S&P. So the S&P since January is now approximately up 15.21%. That's a lot. And let's take a look at Apple. Apple is up 16%. So they're break even between the S&P and Apple. So Apple is actually a very big component of the S&P, and as the S&P was ripping higher, it was kind of weird to see Apple not moving higher, but I guess it really ripped up off that 200-day moving average here with that ideal trade setup. So that's a signature play there. Okay, so that's about it. Does anybody have any tickers that you want to take a look at? So Netflix is there. Tesla. Oh yeah, we gotta go through Tesla to see if that one's going to work for that TGIF. So let's go take a look. Just plain and simple on the daily time frame. We have 2 red candles on the daily, still trading within the Darvas channel. Obviously, the Heikin-Ashi candle is red. Okay, but we can see that there's an A6 coming in. This doesn't really look like an ideal trade setup, but it did break out on that short squeeze purple D there. The A7 here is showing that it is a potential ideal trade setup. So that's why this trade in Tesla, once it starts picking up, I think in August, it's going to make a run up to $1,000. Earnings is sometime in July 26th. So unfortunately, the problem is with earnings just around the corner, and it hasn't been, is it confirmed? It's estimated, right? No. So Tesla earnings, it's confirmed on July 26th, and it definitely does not look like it's running. So I would say that it's probably July 26th. There's one more TGIF left on this Tesla trade going into Friday. If it's going to make a run. Because the contracts for Tesla get exponentially higher in the, actually next week is the earnings week. So they're all jacked up. So the $800 calls. Oh, the 23rd contracts. So the $700 calls for $390. We'll have to see how those look. They dropped by 50% today. I don't know if that's a sale. So they were up today at around $6 or $8 today. And then because it pulled back, it's dropped by half, 55%. So that's on a discount at $3, $4. So if I were to get into a TGIF on Tesla with $1,500, then obviously, you know, I'd buy 2 of these contracts for $800 on Friday, and then hold on to my Roku, right? Because the Rokus are now worth about $500 We bought them at 85 cents. Lost 200, about $200, 250. So that's 850 plus 800. That gets us near the maximum allowable position size of 1500, right? So then you pick up 2 contracts on Tesla and 10 contracts on Roku. But that's assuming your position size is 15% of a $10,000 net liquid. If it's not, then you'd have to pick up 1 contract of Tesla for $300. And if $300 is still like too much, then you'd have to go and pick a lower delta. And I would suggest either the 720 or the 715. And the interesting thing about Tesla's strike events is that they actually increment by 2.5, which is good because so you want to be within your last, if you're going to pick anything higher than $710 strikes for next week, you got to pick them up either at the end of the day or on the dip, because those start to increment by $5 after 710. So the decay is a lot more deadly. As for Roku has earnings that's still not estimated, August 4th. So there's lots of time for this thing to run. And I would think that it's probably not going to run anymore because all the focus is on the FANG stocks. So having said that, and actually taking a look at how the market has been trading today, I would probably start to move away from Roku until it starts to pick up on the earnings run, which is scheduled in August. So we need to get past the rest of the FANG stock earnings: Apple, Netflix, Amazon, Google. And once those are done, then Roku will start to come back. I think the last earnings would be Apple. Apple's earnings are on July 27th. So July 27th is a Tuesday. So I think Roku starts to pick up on July 29th. TGIT there. So I don't think the TGITs are going to really work for Roku after thinking about it, based on what all the activity that's happening from the 14th and the 27th. So you got earnings from Netflix, earnings from Apple, Google, Amazon. That's gonna be moving money around those stocks, while all the other companies are gonna be like Roku's gonna be just watching, right? So that's what I would. That's how I would interpret the price action. Okay, and let's see what else. And and finally, so before we end the focus session, the Wolf Wave indicator will be out after I test it one more time by the end of the month, and that will be free of charge for everybody in this community. And I also picked up a couple of servers for the retirement account. So if you're looking to create a financial security with high probability of success, let's take a look at it. Basically, we have a actually one of the things that kind of compounding interest calculator. So after like going through all this stuff and trading options, the whole point, I think if you understand it a little bit clearly, the whole point of trading options is you got to compound your profits. If you don't compound your profits, you're not going to be making money in the market unless you get lucky on those big wins, like a stamp trade. Okay, even like the Alibaba trade that I made this year, it was great, but I think it was like I put in like 10,000 and made like $76,000. It's like not that much, right? When you have to pay taxes and you have to, it's just one big spike in the curve. So in order to make a lot of money in the markets, you've got to make profits, use those profits, and reinvest back into the business, right? Kind of like running your own business. And that's through compounding. So if you're interested in this retirement account, you get a $50,000. Let's say you start with $50,000, and the probability of success is around 98%. So there's a 98% chance that you're going to make this much money. It's just the only thing that we don't know is if you're going to be alive after 6 years, because you got to stay healthy. Like I said, I almost got hit by a Chinese lady while the walk sign was turned on, and I was walking across the street after paying off, depositing a check. And the Chinese lady in her Model 3, I know exactly what she looks like. I remember her face in her car. It's a white Model 3. She almost ran right into me. Okay, so these events can happen. Anyways, so the whole idea for the retirement account is you have, if you have a $50,000, let's just say your risk is $50,000, and you can have that invested for 6 years, because compound interest starts going exponential on the 6th year. This is a great website that helps me kind of explain it. But you put in $50,000 and you have 0 withdrawals, and there's no deposits, and the design of my system is around 70% gross. Okay, and we're going to run it for about 6 years. Compounds annually, right? And this is how compounding works. Okay, you can see the histogram. It just goes exponential. Whenever I take in new clients for the retirement account, the first year is always tricky, right? Look at that. It's like most of the time clients come in at the 52-week high, then they see the system drawing down, and then they say, oh, Roger's working, or what? What's happening here? And that's that right there. But good thing that I have the design plans and I know exactly how it works. Okay, I just have to entertain them enough so that they believe me, which they should, and just hang in there for at least 1.5 to 2 years. And after 1.5 to 2 years, their account should be more than doubled. Okay, approximately. And so this is so that's 1.5 around here, and 70% is the design target. So we kind of sometimes run up to about 150%. Sometimes we get 35% per year gross. But over the 5 to 6 years, it averages around 70%, right? Well, that's how I designed it. So then the total profit, if you still are living on this planet Earth, and then by the year 2026, you should have about $1.1 million in gross profit. Gross. So if you're a trader and you never ever pay taxes on your trades, then when you come over here and you making money like this with me, you better get your taxes all sorted out, okay? Because this is no joke. You're making real money now. For options, yeah, I mean, you got to follow the same idea. You got to compound your profits, right? So instead of thinking of these as years, you got to think of these in terms of weeks, just like TGIF. So if you actually think about it, in the big grand scheme of things, with a very, very small risk of $800, you TGIF something and you make, and every week you're compounding, okay? But your probability of success is really, really low because the returns are huge. It's like each week you're compounding like 40%. So let's say we did $850 initial principal, and we do 35% per week for 1 year, and we compound this every week. Compound frequency every $35, is that right? Monthly, we're not withdrawing anything. 35. Yeah, this should be right, but there's nothing. That's a one-time. So the frequency is can't be weekly. So I think there's something wrong with this frequency. I guess it can't handle, the formula in there is not correct. It's only doing it once, unless I'm missing something here. Initial. Because it's not showing, still show. Oh, maybe it's. Is it weekly? No, there's something wrong with the calculator here. It can't do. It's just too big. So anyways, with $50,000 and we go back to a gross of 70% after 6 years. Yeah, because this is years. This is the problem right here. It won't, it has to be weeks. But let's say I tried to fudge the calculator assuming each year is a week. So I'd have to put each year is a week. So that would be 52 of 850. Compounding 35 on a weekly basis. 52 years. What was that? 12? Yeah, so I'm fudging it. So that would be January, February, March, April, May, June, July, August, September, November, December. Okay, so it's a little bit. 1, 2, 12. Yeah, it's January, February, March, April, May, June, July, August, September, October, November, December. Yeah. Here we go. So I fudged it, right? Well, you got me. You got to get to watch an engineer think through and backtest. So that's how it works. So when we go back to that TGIF sheet or the focus session sheet, where is it? So 825, and we do it to the how many weeks is this one? That's 5 weeks. So that's like not even it's like 2 months, right? So 2 months with 825 with and then we're actually looking at 100% return, right? So month 1, month 2, month Yeah, so we're right around here. About $10,000. Yep. So you can see that, I mean, you'd have to hit every single win, but $825 and, 35% return. And there's 12 months in a year, and we're compounding on a weekly basis, right? So why 35%? Because let's say we don't hit on every single trade 100% winner. We get 50% losers. So 50% loser with 100% winner. So it's like 50%. So let's just say 35, assuming some slippage and execution, right? Because you never know if you're getting the best price. But let's say 35% return, assuming all your losses. When you start off with $825 and you use your theoretical profit, which is the 35%, then on week 1, week 2, week 3, week 4, week 5, week 6, week 7, week 8, week 9, you should get to around, so $5,600 dollars for the 9th trade, which will take your account up to $18,000. So that is that's the power of options when you compound it. This is the TGIF strategy. And that's your goal, is to follow that plan. Like your plan, your financial plan to trading options is this assumes you go all in. No, this assumes you go all in on 35% of your profits. So you're not going to get 35% all the time. Sometimes you get 100%. Sometimes you get like 200%. So you got to use 35%. Right? Does that make sense? So this one right here assumes 100%. Right? The decimal odds is 2.0. So that's a risk 1 to make 1. So if you but here we're assuming 35. So if you win on the TGIF with 100%, then only use 35% of your profits, and then you'll be following this plan right here. So we'll call this the options financial retirement plan. And this is about 60, let's say 60% probability of success. So I'll post that here and to make it clear, right? And then we'll go to I should take out the horizontal axis is incorrect because that's based on years, because it's supposed to be months. So it's because there's a problem with the calculator. So that was, because I'm an engineer, I don't give up on problems. I can solve it pretty fast if I think about it. But here's that's the growth model that you want to follow. So what I'm saying in short here is that if you're trading options, right? And I know, you either believe me or don't believe me, but if you're going to make money in this market, you got to compound. My retirement account system can't make money if it can't compound, right? If you don't make dollars, you don't make cents. So you got to compound those profits. Otherwise, you're gonna resort to yourself just trading the way you are for a very, very long time. So if you compound your profits in Apple, right? If you buy stock in Apple 10, 20 years ago and you hold it, right, for that many years, then your model, your profit model is actually just a simple model. It's a simple interest. But that's not going to make you rich. You have to compound it, right? So you got to take those profits and rebalance it such that you have that compounding effect. If you don't have that compounding effect, people who are trading options, they're assuming that it's compounded because you're getting 100% return. But you actually have to take a bit of that profit and put it back into your strategy in order to feed the beast, because that's how you're going to get this model. If you don't, that's actually an $825 investment turns into $53,000, assuming you hit all TGIFs. That's 12 trades. So if you can make, is that even correct? 52 trades. If you make 52 trades with 35% return, and all on average, right? So that means you can make 100% and take out 35% of that and keep 75, and you use the 35% to compound, and you do that 52 times, you should have $53,000 by the end of the year. And that is your financial plan. This is the focus session. That's why we do this every week, just to reiterate this, because you start day trading like somebody with like a trigger finger that's happy. You're just firing at everything. Then your financial plan disappears, right? Because it's not following this. You gotta trade. So TGIF, financial trading plan. So this is not risk management. This is what your goal is. And now the nice thing about what I just did here is this allows us to define some very important key parameters, okay? Or answer some questions like, how many trades do I need to make per year, per week, per day? Okay. Well, so the question here is pretty straightforward, right? Question number 1. The answer is 52. 52 trades per year is the theoretical trade number, right? So 52 trades. If you do 52 trades per year, that's how many per week? That's just 1 per week, right? Because there's 52 weeks in a year. And how many per day? 1 per day. So that puts things into perspective. Can you believe that this is... Can anyone fathom this? Does this make any sense? Or do you think did I get the calculation wrong? Or am I making this all up on... Is this wrong or right? Anybody here with who can, rebuke this, or anybody? So if you make 1 trade, not 1 trade per day, that's wrong. How many trades per day? I guess it would be 0.0, well, it'd be like 1 divided by 5. It's 0.2. 0.2 trades per day. Right? Does that make sense now? Someone's calling me. Hello? Okay, thank you. I'll come down. Okay, I'll be back in about 5 minutes. Someone from Amazon's here. But think about that. This is I'm teaching you some very important stuff. So, oh, you're answering Drazik's question? Yeah. Yeah. So, yeah, basically, in order to, so this is the focus session is just kind of helping everybody see the light, see the path forward. Because what do you think like day trading does? Like, what do you think those Japanese candlesticks do? They're just sending subliminal messages, right? They're flashing red, green, right? And if you coordinate the flashing enough, then it probably will affect your subconscious, making you, itchy, making you, do things that you don't want to do, maybe over position sizing and all these things. But when you simplify the markets in terms of risk and reward and strategy with Kelly, right? Then you are making, then we've pretty much taken all the meat off the bones, and we've got the skeleton here. And we've got it right here. $825, 35% return, using 100% of that 35% back into the next trade. And if you do that successfully, 52 trades, then you should reach about 53,000 by the end of the year, right? And of course, if you do have a little bit of an account, it doesn't take that much. Let's say you have $10,000 and then use 1,600, 16%. Then there is a good chance that you lose 10 times $16,000, and you still can make $103,000. Well, minus 16,000. So that would be what, 90, 97, 90, 80, 80, 83. So that's just the way it works. And I basically simplified it so that you can now control your day trading. You now can see the path forward to what your goal is, right? And there's obviously, knowing this is not going to make your next trade a winner, but at least it tells you, keeps yourself, wearing that seatbelt every time. Now you know why you're not trading again and again and again. Now you know what to look for at the end of the week. And it takes, basically, if you hit a 200% winner on a $825 trade, then you can actually, you're basically on vacation for 2 weeks, right? Because you've made more than the 35%. And you just have to make sure that you find the next trade that has a 35% winner. Now, it's not always going to be like this nice steady path that goes up exponentially. So you do have to, that's why this risk is really, really low at 825, and you're not using like 100% of 100% profit. You're using a percentage. So that 35% is assuming you're using a percentage. And when you take a look at the results here, if you lose on a trade, let's say we're not compounding. Let's use simple. So initial compounding frequency, that would be, let's say we lose once every half the time on a bi-weekly basis with $825. It's not going to work. The formula doesn't work on that, does it? Bi-weekly, semi-monthly, monthly would be compound. Yeah, that monthly would make sense because you can lose a couple of times in there. So even if you lose a couple of times, you still make $50,000. That would assume how many losses? let's take the profit rate. Let's say the profit is just even 5%. Yeah, 5%, you're not going to be doing anything. So 50 weekly. So anyways, going back to the retirement account, if you have $50,000, so the probability of success of reaching 825, compounding 35% per week, you get $50,000. If you're averaging 50% on each trade, and you're using the whole entire profit, apparently you're going to make that much. So 825, 521, starting principal, total interest, the balance of that, and then you make another 50% of that. Yeah, so you'll get into the butt clenching range here on the 5th month. That's what I kind of outlined here in my PowerPoint slide. The butt clenching. So, you know, that's hard. So that after that point, you know, you'll get into a little bit of a dilemma because the risk is so high. But, you know, obviously you only risked 825 at the beginning. So that's why it's a 64% probability of success, because you can get hit on one of these trades like right here. So you can say you're at the 14,000 and you take a 50% hit. So now you're back at 8,000. So then you could move one step forward and then like one giant step forward, and then all of a sudden find yourself 2 steps back. And that's the problem with the options. So you got to be very, very, you have to have a strategy that has that type of success rate. Now, retirement account, the 750R that we're using here, basically with $50,000 is the minimum. And then we're not making any withdrawals. The design criteria is 70%, and the time required is 6 years. So obviously now we're using years instead of months. So the time scales changes vastly. A lot of things can happen in 6 years, right? Especially Chinese ladies driving you over. And then we do this annually. And here you can see that with $50,000, with an annual return of 70% per year, your total gross profit is $1 million. So that's over 6 years. And when we did $825, that's $50,000, right? In 1 year. And then if you do that for the next 6 years, 825, 825, 825, multiply 6 times $50,000, that gets you to $300,000. Okay. Now, obviously, you can change the position sizing once your account grows more, and you'll make more. But assuming you just kept it the same, then you'll have $300,000 using the 825 amount. So with the retirement account with $50,000, you have a 98% chance of making $1 million in 6 years. It's almost guaranteed. Actually, I can almost do some statistical analysis to see what kind of things I can do to use the word guaranteed, because obviously when you pay taxes, it means you have guaranteed profits. That's one of the biggest problems that people have in most of my clients, is like the taxes. So this is $50,000 of gross profits, right? And then basically we divide that by 2 to take into account the net. So your actual return, your profit, is actually $252,672 at the end of the 6th year, using $50,000 with no additions, and that's doing nothing. So it's a bit of a, you're in options, you're doing something, you're taking risk, and you're making big wins, and you're trying to do that consistently. Whereas the retirement account is doing 252,000, which is approximately how much you would make if you did $825 every year in options in 6 years. And you're doing nothing, and that's after you pay the taxes. Because keep in mind, when you make money in the options, you still have to pay taxes. If you don't pay taxes, they're going to come after you sometime. Okay, and then you're going to end up, if you didn't change, if you're a day trader and you're trading often and you didn't elect a mark-to-market election and all that stuff and declare that you're an active trader, your taxes all messed up. So that's not going to be good. So anyways, there's a 98% chance. So we have 60 people, $5 million that's doing that. So we have $5 million. And if they stay with me for long enough, well, the average account size is around, I think it's $80,000. About the average, so 60% of the people who have a retirement account in 6 years, their total net worth will be around $500,000 after all the taxes have been paid. And then if you do an LLC, then you can add an extra 20% to that. So that'd be, like, let's say just 50%. So their profit will be around $831,000. Okay, because they're going to be, obviously driving. Then somebody asked me if I should talk about all the tax advantages of having an LLC. There's a lot. I highly recommend it. Okay, so especially if you're an option trader, you definitely need to, offset those commissions. One way you can do that is through an LLC, but there's a lot of benefits to it. You can, you would never ever lease a car, buy a car. So as option traders, we are very familiar with time and premium. So basically, when you have a system that generates profit, you can lease a car and then always change to a new car every year by expensing it as a business. You can offset a lot of the things like gas, electrical bills. My client has a private jet because he's making so much money. Also has like his own like when you get really rich and you're making a lot of money and you turn your business into your pleasure, then what happens is you're opening up vodka, you're opening up bars, restaurants to your friends and family, and they start to generate revenue for you and all that stuff, right? And then you can expense it, and you're just getting richer because you're offering a service. But there's a lot of benefits to it, and the difference to your account would jump from 35% to $400,000 into $800,000. So that's a huge, because you're paying about 20%. This is how much tax you'd be paying over the 6 years because of the system. So $158,000, and then including my fees. So it'd be like 25. So it'd be paying about $225,000 over the 6 years, and then to make it, around 50% on the LLC. You'll be netting about $830,000 because the design criteria is around 70%. So you got $1.8 million of gross. Okay, and that's not all your money. All that, there's expenses you have to pay. There's a lot of things you have to pay out of this 1.8 million. So it drops down to 400,000 conservative. So that's Based on my design, you got about 98% chance to grow $80,000 to 400,000 over 6 years. And some of the problems that happens in the system is that, well, first of all, we had an incident last year where people are joining in the retirement account at the 52-week high, and they joined in with like $50,000, and it was drawing down like from 50 to 56. So they quit and they called me a scam artist, right? They said I was a scam artist. And I said, well, they quit after 4 days, 1 week. So 1 week going into, it was like November, into the Donald Trump election. The system started to draw down. But most of the people who started in January weren't drawing down. They were actually up for the year. It's just some of the profits were being given up because of the uncertainty of the elections. And then all of a sudden, bada bing, bada boom, it just took off and made all that money back. However, they closed their accounts. They forced me to close the positions, which I was like kind of scratching my head because I thought they were, doing a retirement account. But what happened is that it came to a point where they were micromanaging their account, giving me updates on how the account was doing every single day. And that's why micromanaging is not like a very popular way of management, because you're so involved on every single task that you don't like what's the whole point of, like, what are you trying to do? Like you have to create a plan, and then you stick with the plan, right? As long as you see your year-to-year growth, which the first year is always difficult because you can see in the shaded gray area, the principal is a lot higher than the interest. So any little dip, like at the beginning of the year or beginning of the system, can induce some butt clenching, right? But once you get past that first year into the second and third, by this time you're pretty much retired. And the main problem here is after the fourth year, you can't add any more money unless you actually have like an extra $80,000 lying around. And that's because when you like do your contributions from 2021 to 2023, you're just kind of changing the shape of the histogram so that it's actually shifting to the left, so that you're speeding up, you're reducing the 2026 goal to 2025. But once you get to 2024 with no contributions and you start to contribute at this point, you can just think about it like this way. So now you're on 2024, you should have about your balance. That's net. So let's say 70. Well, after all the taxes said and done, it should be about, let's just assume 35. So after everything is said and done and you paid all your taxes, your account is going to look like $265,000 after the fourth year. And adding to this account, you would have to have about $28,000 in order for it to actually move it. Because if you contribute something really small, like $500, it's not going to really change the system that much. You have to add, I would almost say about 20% of this amount at the end of the year. So that'd be like six. Basically, you got to add about, this is aggressive, $60,000 per year over the course of the year. It all has to add up to 60,000. I guess minimum would be 30,000. So about $30,000 per year at this point. And then when you get to here, you'll probably be 65,000. So it takes off pretty fast. And then obviously when you get to like the 10th year, it's at 1.6 million. So let's say your account is at 1.6 million on the 10th year. Holy cow. I'll be 51 years old. So if I have 60 people with 1.6 million balance, well, that's net. So it's a bit different. I don't think I'll be trading, obviously. I might actually. But at 1.6 million, you can't really contribute anymore, right? Because if you think about it, if you throw like a loonie into a $1.6 million account, it's 30% of a loonie is like 30 cents. And even though it's money, it's not really growing that much. So you gotta think through that carefully. Like, this system is pretty robust, and at the same time, if you think about it outside the box, and you start off with 50,000, right? And every year you're making 35% net. After 6 years, well, actually, just every year. And 2 years, you make a combined profit of about $41,000, right? That's after you paid all the taxes. Then you can actually use the money from here to feed your option desires and do that $825 and look to compound your profits, using the TGIF or whatever strategy you can find that can compound 35% with a high probability of success, right? Because it's just, like we said, like if you take $825 and you compound it 35%, for every week, TGIF, right? And you do that for 52 times. There's a couple of weeks where there's no TGIF, right? Because long weekend. So it'd probably be like less than that. What would it be? 825 to... I think we're not depositing anything. So 35%, 12 months in a year. And we're doing this every week, right? So we'll take out 2 of those weeks. So that would be about 37,000. Like that's like conservative. So your goal actually for options, assuming a couple of hits. So I've taken, so now 12 months, I put, let's say to 10 months. So in 10 months with $825, you should be able to make $26,000. Okay. That's like the bare minimum. And that's taking only, how many trades is that? So in 10 months, so 40 trades. 40 trades. So 40 out of the 52 trades, a couple of those trades, it's long weekend, and a couple of trades you lose, then you should be making about, with $825 per trade. So let's just copy paste this right here. And put it into the spreadsheet. So this is, I would say this is the trading plan. We call this theoretical assumption. Theoretical. And then the next one would be called practical or applicable. So it wouldn't be 53,000. It'd be, assuming this assumes a lot, right? Well, it actually assumes a lot of things that actually do happen. So that would be how many trades per year? So that would be about 40, assumes 40. And that would drop, that would be 1 per week, basically. And still the number of trades per day is 0.2, right? So in 40 trades, and it doesn't mean it has to span out for the whole entire year. Okay. You can make 40 trades in one day, but you can also blow up your account in one day too, right? In 40 trades, in theory, if you made it all in one day or all in 1 year, you should have $26,000 in your account. If you are compounding 35%. And that's actually what happened to me last week. So my account went up quite a bit. But that is, so it doesn't matter. This one here is like is saying how many trades do I need to make per year. So it could be per year. It could be, you can ask the same question and it could be the same thing. Like it could be 40 trades per week and you can make $825 turn into 26, right? But then obviously the problem is, are you fat? Every time the market moves up higher, every single ticker is moving up like hundreds of percent, right? So then after you close your position, you know, all the market starts to pull back, and then, you know, what are you trying to, you know, you can't, there's only so many trades a human can make unless you have it automated, right? So, and then the strategy in a day trading strategy, like hitting 35% winners every single time, that's going to be, it's not an easy task. So what I've done here essentially is kind of created a theoretical model for what your expectations should be, especially if you're onboarding. And that's why I developed the TGIF strategy, so that you can easily double your account, right? You can easily double your account as long as you, manage your risk. So it's $825. And assuming you lose a couple times, right? So now instead of 52 trades, you got 40 trades. You're still making $26,000 at the end of the day. Well, not at the end of the day, at the end of the year. Okay, just using $825, but compounding. So that is, and that's assuming a 35% return. So, you know, most of the average winning trades are averaging around 100 to 75%. But then when you go through a couple losers, it takes you back takes off like maybe two winning trades from the 52. So you got 10, I think if you put this into perspective, you got 52 attempts with $825, which is 825 times 52. That's $42,900. That's a lot to lose if you lose every single time, right? But based on this, it's saying 62% of it, 64% of it, of that money, that 42,000. So how did I get 42,000? So $825 times 40, or actually 52, right? Well, 40. Let's do 40. 825 times 40. That's $33,000, right? So that is like, this assumes every single trade is a loss. Okay, if you lose on every 40 trades, then you lose pretty much your whole, you lose that much money, right? And then, but the back testing says it's only 64%. So you're winning 64% of the time. So that means like 36% of that money is max risk. 33,000 times 0.36 is $11,000. So even if you screw up bigly, you should still, in the absolute, this is so max loss assuming 30%, 36% losers, or we call it risk of ruin, then you still should come out with 26,176 minus 11,880. So that'd be, still come up with 14,296. So even in the worst case scenario, you should come out if you have a strategy and you're like, let's say you're the worst trader in the world and you just like nothing is working, but you just follow that strategy using $825 and a little bit of compounding and assuming 36% of the losses, you should still come up with a profit of 14,296. Like absolute worst case scenario is 14,000 profit. So not really a loss, right? When you look at it from a net perspective. So this is pretty interesting, eye-opening details that people don't really put into perspective. But if you do that, you can see that in theory, if you do the TGIF and TGIT, and you have like an idea of how many trades you should make per year and per week, then you reduce the number of trades and then you use $825, then you should have, in the worst case scenario, $14,296 in profit. And then you got to pay taxes on that. So you probably end up like with $8,000. However, so then what people do when you increase the frequency of trades, obviously this goes up to 104 trades per year, and then you increase this to 2, right? Then that means that your profit should increase as well. Now, yeah, is that true? If you increase, I guess it's true, right? I think it's still 1-to-1. There's no funny things in between it. Well, the only funny thing is, no, actually there is a funny thing because this assumes one strategy. So then if you have a strategy that has a 60% probability, right? And then you want to increase the number of strategies, right? So they're both, now you got 60% and 60%. Well, 60% times 60% is what? 0.6 times 0.6. That means your probability of success drops from 60% to 36% because you picked 2 strategies. So increasing the number of strategies doesn't necessarily mean you're increasing the number of increasing the profits proportionally or exponentially. So you got to be careful with that because they're both independent of each other. And because they're independent of each other, multiplying 50% with 50% gives you half, right? 25%. So you're increasing the risk of losing more money. So trading less is more. And when you understand that and you put things in perspective, then you can kind of manipulate the numbers so that you can fit this model and then end up making $14,296 minimum from trading 40 trades per year or 40 trades per month or 40 trades per day. Obviously 40 trades per day is not possible. I don't even think anybody, well, maybe Bags can do 40 trades per day, but that's probably like round trip. But yeah, you gotta keep this in mind. That's the whole point. So that's why I say that if you're gonna, like, with the financial planning of your, like, 5 years down the road, I know that, you know, a lot of people are gonna make there's gonna be like, I think there's like 10 people that are gonna be millionaires from this Discord room because of, you know, what we do. We have one person that's probably going to be making 15 million. We already have one person at 27 million. We have a couple of people that are going to be close to $1 million, maybe $500,000 after the 6 years. But down the road, that's something that we can see actually happening. We have a plan, and that plan, if I break it down to everybody, is the plan of compounding. Okay. So once you compound your profits, you know, like I mentioned before, the strategy and the setup. Without a strategy, how do you know how to calculate Kelly? Like, how do you know when to use Kelly, right? You need to know that probability of success. Somebody has to back test it and do some number crunching. Okay. And once you do that number crunching and you have the probability of success, then you can, work with Kelly to figure out what your risk is going to be. And then you can then develop a model and figure out how long it's going to take you to make X amount of money. If once you have that all figured out, then you have a financial plan. Okay. Coming into the market, trading off of alerts and bending over is not the right way, because there's too many things, too many uncertainties that are coming in, right? And you got to eliminate that all. In today's focus session, all I've done is basically simplified or re-emphasize the popular acronym KISS. Keep it simple, stupid. And if you keep it simple, right, and know your plan, then you're actually subconsciously forcing yourself not to overtrade, because that if you got 52 trades in a year, and let's just assume only 40 of them are going to work. Once you lose on one trade, you still got 51 trades left. Okay, you don't have to force that next trade on that same day. You just wait for the next TGIT, TGIF. You can lose up to 10 times and still make approximately $14,296 after all the $825 risk of ruin of losing 36% of of 820. Every time you lose $825, you can lose that up to $11,000, and you still make $14,296. By putting this into perspective, you can actually understand your risk. You can control your tendencies, and you always have a plan, your backup plan, which is always going back to your TGIF, TGIT fundamentals. I've also seen situations where TGIF didn't work, right? And it goes like we had one time during the Trump administration, like Apple announced like earnings warning. Like it's like they're announcing that their earnings are not going to be good, even though they're announcing in the end of January. They released it in January the 3rd, right? And it dumped like 10% on Monday on a TGIF cycle, right? So those things happen, and you pretty much lose your whole entire money, but you still have the whole year. That's just one out of the 52 trades left. You have 52 trades, 51 trades left. You just lost on one, right? You can lose up to $11,000 and still make $14,000 using 825, and that's assuming a 35% compound. So once you have like your plan, then you know where you're going to be in the next 6 years. That's the most important part. And then once you know where you're going to be in the next 6 years, what happens is, I'll tell you what happens to me. Well, it's a little bit different for me because I'm managing a lot of risk, but I don't really have that much concern because I have such a huge advantage. But what happens is, you become more focused on your health. You start to focus on your longevity, your well-being. You start to filter out things that are going to affect your life, like stress and smoking. I used to smoke. You start to pick foods like grass-fed meat or free-run chicken or avocado chips, avocado oil-based chips. All of these things will increase your longevity because you need to make sure that you stay around long enough, healthy enough to spend that money. And that's the worst thing that can ever happen to anyone, when you make all that money and you don't spend any of it. Okay? And we always can think about that tragedy with Kobe Bryant, right? That was like, we have like people in this room while we were trading during that time when Kobe Bryant got into a helicopter. That's a crazy 4 standard deviation. And it can happen. Like for me, I don't know why I'm almost getting hit by cars twice a month. But these things happen, and you have to prepare in advance, because you need to be able to be around after the 40th trade or after the 6 years to be able to reap the rewards, because you're basically working 6 years to make that money, right? And then using partial profits to pay the bills and then continue to compound. But over trading stuff can be also an event where you blow up and make bad decisions and wipe out the whole entire account. So always coming back to the plan of focus session is the key to your success. And looking to day trade, obviously, how many trades are you willing to take per day, right? If you have profits, then I understand that you can take a bit more risk and increase the number of frequency of trades you want to do. But when it comes down to it, when you take all the meat off the bones and you just got the bones left, you only need to make 52 trades per year, 1 trade per week to make $53,000 theoretically, okay? But if you apply it, it turns into 825 trades. $825 turns into $26,000 after the 40th trade, assuming you're able to compound that. Okay. And keeping a ledger helps you track your success. So sometimes you might see at the end of the week you're up like 200%. So that's great. That means you're like 2 weeks faster to achieving your goal. So now you take those that 200% profit, use 35% of the initial, and then you compound that and try again, right? You basically have more quarters to play the video game. So that's very important. And yeah, I highly recommend it. And that's why we have the retirement account. So if anyone's interested in the retirement account system and you want to like secure your financial future in the next 6 years, contact Andy. He'll be, he's there. But definitely, I mean, to me it's like a no-brainer. Like it's 6 years down the road, you have a path of reaching a 6 to 7 digit account, and after that you retire, and that's the whole plan. I can't imagine being trading options when I'm like 51. I think there's like I said before, with the strategy there's always a time component, and yeah, with trading, obviously you don't want to trade forever, so it's gonna have to come to an end sooner or later. I think for me it would be at around I'll probably stop trading at around 49. If not 49, then 69. But definitely I want to try to stop trading at the age of 50. I think that's a very good number. At the age of 50, I'm pretty much done. Yeah, because there's other things better to do, right? So that's the plan, and I think I've gone over the trading plan for July 15th to 16th. We have all these positions here: BKNG, Disney, Netflix, and Roku, which is not working. Got a potential bullish day tomorrow. Futures are down, and yeah, here's the equity chart. So this is using, I think we went down as low as 1,600. Look at NI. Is that a ticker? Let's take a look at NI. Oh yeah, that's a beauty. Little had the nice little doji there. A6. Is that a gap right there? 76. A7. Ooh, A8. This must be energy related, like crude oil. What kind of company is this? NextEra. Like, is it crude oil? Is it crude oil energy or nuclear? But it does look How liquid are those options? They're monthlies. Spread is pretty nasty, so you got to go in the money. This one is a good long-term play. Wow, look at the option contracts here for the leaps. Somebody bought 2,435 calls on this thing at $2 a pop. That's $487,000 that they put in there. Jesus. So they're obviously looking for at least 35%, I'm assuming. So that's they're looking for $170,000 profit. How much these things moved? So today it moved up 1.12. So how much changes that? 10%. So they made about 10% profit on a $487,000 trade. So maybe 35% is too low. Maybe they're looking for 100%. You picked up 2 calls for the 77.5 for next month. You know what? Like if I were you, I'd just pick up 1 for next month and then 1 for this leap year. Or basically, yeah, and then once they double, close one off and then just leave that alone. Because you got an A8 there. Take out $90. Those things move to $90, then your contract, those $100 turn to $360. So that's like it's good return there. You don't have to do much on that. You just have to kind of make sure that it's still moving higher, which I think it is because it's got an A8, A6, A7. That A7 looks crazy. See that ideal trade setup on A7 with the Hikinashi candle? Looking good, but yeah, the earnings there is July 19th. So that one, I'm not too sure what you do between earnings. So you got 2 contracts for next month. So you're going to hold those into earnings? Let's take a look at some other tickers here. I haven't. Airbnb is getting toasted, so it's actually, that's the most bearish rounding bottom I've ever seen in my life. It was so bullish here on that BLT and then failed, but now that looks super bullish, bearish on the E6, but there's no gap like underneath it, so I can't imagine this thing making a new 52-week low, but it could be the case. Wonder why. AMC, oh my god, AMC is down 15%. How come I don't look at these things off that A6? AMD, ARMS, Amazon, ARC, oh my god, ARC. Jesus, this Kathy Wood is really something there. How much is it up? It's, oh my god, it's still down. Oh, it's down 6% year to date. I wonder if that's similar to Tesla. Tesla, is that down 6%? So Tesla opened here January 4th, and oh wow, Tesla is down 9%. So I guess, yeah, Kathy Wood is doing better than Tesla, even though that's her largest position. Very interesting. Wow, I can't imagine that. So you can see that we're, I think the retirement account year to date, we're up 30, 27, 5, 25%. I don't know. We are not at negative 6%. And yeah, she's definitely, I don't know. I think somebody's stealing money there. She might be a scam artist. I mean, look at Berkshire Hathaway Class A shares. How much is this thing? How much is this guy up since January, which is here? They're up 21%. Shit, these guys are good. So that's pretty impressive for Berkshire Hathaway to be up this much. 21, but like I said, it doesn't compound, right? The profits, these are all simple interest. But yeah, Berkshire Hathaway is up 21%, and yeah, so the drawdown here, how bad was it? Oh god, 30%. Yeah, I don't think I'd be alive if ever these accounts dropped 30%. I think it'd just be a disaster. But that is a pretty big drop. But I guess they all believed in Berkshire, so that's why it's still rocking here, up 21% year to date. So from the low here to the high here, it's about 85%. So 85% post-COVID is still, because well, actually, if we do it correctly, it would actually be the profit from, it'd be here measured to here to here. So it's only 23% for how many days? 2 years. So 12% per year. Yeah, I don't know. I don't think that's good enough. I guess everybody was averaging down at the low. Yeah, okay, so let's take a look at some other tickers. These Google's just gone nuts. It's running into earnings. These earnings have been kind of tricky, especially this here, but it's almost at the earnings. July 27th. Nvidia. There's, yeah, I don't know. They better split, because I don't know. There's these gaps here that 557. That's going to be nasty. PayPal. Yeah, it's hard to, you know, when you're like at these up against these 52-week highs. I'm having like troubles like looking for the next trade. Like Shopify, look at that. This one is a bearish engulfing candle, so that's actually a very bullish trade here on Shopify. But it's also setting up for a BLT to the downside. There's no support until 1329. So you can see the complexity of this market now when we're up against 52-week highs. There is an A6, and I wouldn't be surprised that this thing just dumps into earnings and then pops. Boom. One thing about Apple is the Apple earnings. This happened with Shopify a while ago. Shopify a while ago just ran like super hard and long into earnings and then just dumped 10%. So what we need to do, I mean, for those who have a retirement account, make sure you remind me to close off the Apple if it goes long into earnings. I don't know if it's going to beat. That is a pretty crazy run on Apple the past 2 weeks. That's 20%. In just 1 month. So yeah, I don't know exactly. There's a lot of gaps under Apple. So again, there will be a market crash in after 2021. So I don't think it's going to happen this year. I think we still rocket higher. I would not be surprised if Apple does beat earnings, but it's not. I don't think we can see like a 10-20% gap up. I'd probably see like maybe an average of 3 or 4%, which would be not ideal for trading options into earnings if you're expecting them to beat. But I could be wrong. Earnings is a binary event, so making the right decision would not be 50-50 unless you're trading common shares. In terms of trading options, I think it would be almost like 33% chance of getting the right answer, and I don't think it's going to be beating. Well, no, I think it will beat, but it'll just dump, because I think that run up here is anticipating the beat. Boeing, it's already crashing, and it's got this crazy gap at 159. And believe it or not, there's still a gap here at 123. So Boeing has been a pretty tough ticker to trade. And it's got this A6 here that's scanning to the downside. And most likely it will probably, well, I don't know what's going to happen to earnings, but there's so many gaps in Boeing that we have to be careful now that not to trade it to the long side unless there's a very, very clean ET setup. But yeah, the funny thing here is this thing keeps on dropping while the S&P and the Dow keeps on ripping higher. Square. So I saw Square on the 15-minute with a wolf wave, but then it got taken out. So the wolf wave pattern disappeared. So I closed out the position with a loss. I think I lost $200 on it. And now it's got this yellow D, and you can see 3 red candles. So whenever, like, if I'm not around and you're not sure exactly what to think about this trade, all you gotta do is turn on the Heikin-Ashi candle, and then you see the doji here on the Heikin-Ashi. So that could be a doji that begins the next leg down, which means that there's more momentum that's gonna come in with this A6. Or if it starts to rip up higher and form the next green Heikin-Ashi candle, then you actually have like a compounding type of trade here where it's going to make consecutive green candles as it runs into earnings, because earnings is sometime over here in August. So it'll run up like this. However, I don't think a lot of the earnings this quarter is going to really affect other markets because of the COVID. So I think the earnings will be good for this quarter and remain good for the rest of the year. But yeah, this square does have an E6, but the Heikin-Ashi candle has turned red for the end of the day, and that could precipitate into one of these candles right here and then continue trending lower like this because of the A6. So that's the a little bit dangerous, especially when you got the Fed coming out tomorrow. And I'm worried about the pump and dump, because if it pumps, then the profits are going to be fast and you got to take profits quick, and then it dumps. If it dumps and then pumps, then we know that we should get into the market at around 10:30 a.m. because there's a second Fed that's speaking at 11 a.m. So that would be a Fed that's making sure that the dump isn't persisting into a point where it's capitulating the market. If the market capitulates, then yeah, there's going to be a lot more red, which can happen. But I don't know exactly if that's going to be the case, because there's 2 Feds speaking tomorrow, and they can do the pump and dump or the dump and pump, and that's the problem with the Fed. Tilray. Wow, Tilray, I was looking at Tilray yesterday, looking at the Heikin-Ashi candle here, thinking about it moving off that A6, but look at it, just did a complete 180 and dropped down 8%, which is just unreal. It even gapped up a bit too at 1675, thinking that it was going to move higher, but it did the opposite, and that was unfortunate. The trend is actually lower here too. Space. So this was Space buy the rumor, sell the news, I guess. And it really did get whacked. Lots of gaps. So obviously, I think some people recognize it's going to go down to $20. Stamp, unbelievable. This is the ideal trade setup. Amazing. Man, that is the most amazing trade, and that happened on a Friday. So in this community, we try to find patterns like this, and we, if you turn on the Heikin Ashi candle, right? Obviously, it was red, but the low was here and here, so you still had some wiggle room to kind of contest the A6 to trigger cycle 1. So once it triggered cycle 1, it was up 60%. So there's no way to follow through. But when you're working with, like, when you have people like me or some of the traders, you can always ask for a second opinion, or ask anytime, because we want to look for these types of trades together as I keep on teaching and going through the setup. The more eyes we have, the higher probability that we can find trades like Stamp and try to get into them before they make that crazy move off that A6. So nice and long Darvish channel. I don't know how long this one is. It's long. It's about 56 days, 38 bars, and the move was ginormous, 100% almost. No, 60%. So that's what we want to look for. And yeah, I want to find them, but I have just so many tickers, so I can go through them. So Caterpillar's got short squeeze purple D, but it looks like it's breaking down. OIH, I don't know, that's oil, that's garbage. Now, interesting purple D, but looks like it's reached resistance. Uber has a long D. Let's take a look at that D. I don't see it on the daily or weekly. Daily, on my daily, I don't see it. Do you see it? I think it has all become on mine. I think it has. Yeah, we can scan and go backwards. Yeah. Okay, let's take a look at that. What about Goldman Sachs? Goldman Sachs, that's ideal trade setup. Yep. Damn. Good. So 70-minute TTM squeeze. Nice, not bad. So I actually did something a little weird here. That one. So let's see how high it is near the 52-week high. There's a gap there. Okay, so the only problem with like I said today in the focus session, the only problem is the Feds. And unfortunately, I don't know if I'm going to be able to trade effectively when we have two Feds out there. It will be tricky, because one of the reasons why it's tricky is because you got a gap below, and I think you got maybe a gap above. But that is the ideal trade setup in Goldman Sachs. However, it all depends on how it opens up tomorrow, because if it opens up lower than 374, then I think the Heikin Ashi candle is going to turn into a red candle. Right now it's green, so it does have the perception that it's going to break out over 392 and run to 400, which is possible. And I think it's possible because of the oscillator, but I don't know if the Fed is going to let it go let anything go tomorrow. Higher low, and the gap there is close enough to still make it a higher low. If the way to trade this tomorrow for Goldman Sachs is if it does a kicker. So do you know what a kicker is, Tepesh? Do we have a kicker manual here? Yeah, that's a kicker. So if it opens up above 378. So if the candle's red and the candle tomorrow opens above 379, like above this open, open, it's going to run up to $400. All right, so let's take a look at RBLX. So RBLX looks like it had a purple D, and when we turn on the Heikin Ashi candle, we can see that the last two candles have been red. It looked like it was going to go long on these two, but then it did a complete red, and now the momentum is shift. It's going to break down, obviously, right? But that's a bacon. So it's either a lettuce doji day tomorrow or a double B with the A6. And I don't know if there's a gap anywhere here, but from what I see there, it looks like it can make a new 52-week low. The way to trade this is just try to trade it off the cycle. So once it hits cycle 1, then cycle 2, you want to take quick profits on the puts, manage half your risk, and then let it go. Futures are now green. Interesting. Next ticker is MasterCard. God damn. That MasterCard, look at that. Double D's, bacon, A6, going higher tomorrow, that's for sure. New 52-week high is going to get taken out, running up to 400. Damn. Did you just find that one today, Drazak? I think I need to come on voice and keep on teaching this ideal trade setup. But that, look at that. So when you turn on the Heikin Ashi candle here, you can see that the indecisive candle doji. And then, so here, you got to write this down. You got to write it down and remember this. Whenever there's a doji of any kind, Heikin Ashi or regular doji, and then the next candle opens, higher, it's the pivot. So it'll continue moving in that direction for some time. And then when you have an A6 in there, you'll move higher until it triggers cycle 1 and 2. Very, very important to understand. This is an ideal trade setup with massive spring potential here. It's going to go up to 400, I think, by end of the week. Damn it. MasterCard, how come? You know what? Does anybody shop at Costco? Did you know that they only take MasterCard? They don't take Visa? They do? They take Visa? Wow, because the one here in Canada, or where I live, they don't take Visa. Let's take a look. So, Costco Visa cards. So I guess in Canada, they're in bed with Capital One, which is MasterCard. What are the benefits of Costco Visa? Oh, they have one here. That's Citibank. So that's the States. So in Canada, why does Costco not accept MasterCard? More expensive. Costco has an exclusive contract with Visa. Wow, that's weird. Because the Costco that I go to doesn't accept Visa. What a strange world. that we live in. Does Costco in Canada take Visa? Visa credit cards are not accepted at the warehouse. You can use your Visa credit card to buy Costco shop cards at Costco.ca. So, this is just messed up. So only MasterCard in Canada. Very weird. Right? What's the logic behind that? Right? So they can use Visa cards in the States and MasterCard, but they can't use it in Canada. And all of a sudden we're seeing MasterCard rip up on A6. Let's take a look at Visa quickly. Doesn't care. It's just making money. Jesus, how come we didn't get this? This one is not clear on that A6 with that doji, but probably has an A7 in there. I had an A7 double DBLT. Oh, damn. I don't even have Visa and MasterCard on my radar. That sucks. It's all tech. Next ticker is Visa. Yeah. So, if we kind of look at Visa and MasterCard, obviously I would have taken the MasterCard over the Visa. And I think MasterCard is actually going to rip up even higher because it has the A7 in there. So that is actually a really good, MasterCard is going to rip. Earnings are July 26th. So how many more days? The problem is, I don't know. Well, you'll have to take the risk of taking this trade. Actually, I might take that trade for an earnings run. Or I might TGIF it. Is there a 70-minute TTM squeeze today? Today it moved up 1.85, so that's a big move. So the daily candle on MasterCard is a bacon. It had a double B, obviously. If you got in on that bacon, you would try to get in on the lettuce. Ends up becoming a bacon, double B. Now you got a bacon. Last time we saw these bacons, we had Roku doing triple bacon, quadruple bacon. Goddamn, with that A6. I don't know. Could it be a triple bacon with the two Feds speaking tomorrow? Where's the 6-day moving average? It's so extended. I don't know. But definitely moving up to 400 and higher, maybe 420 into earnings. That's a crazy looking ideal trade setup on the A7 there. Bacon on the A7 on the weekly. Double B on the weekly for next week is possible. Look at that A7 right there. So if we get lucky on a dip on these things, I wouldn't mind picking it up for next week's contracts for a double B on the weekly. And that will take out 403. Let's take a look at the contracts here on this option chain. So I wouldn't go, I guess you can go out as far as July 30th. So if you want to like a secure trade, wow, those contracts went up 80% on the earnings. So you just pick up the 415 or 420 calls. If you don't want to take that far out, then you can pick up the $400 calls for next week. They will work, but preferably you want to buy it on the dip. That's something that I need to write down. 164%. So these ones, MasterCard and Visa, they're obviously not the ones that make the big moves like 5, 6, 7% moves, but they do make moves, and you need to be a little bit patient with them. They're not the high beta ones. So Drazek posted their MasterCard profits. So he sold the spread. Sold the 390 calls. 390 calls. And you bought the... Oh, okay, yeah, I see. Yeah, I mean... That's the July 16th. The next ticker is Citibank. Citibank. So it doesn't have. So the ideal trade setup is a little bit under contention here, since it's outside of the Darvis. It does have an A6 and it's got earnings. So earnings is July 14th. Did it have earnings already? Not sure. What do we have here? I screwed up and sold a call. Yeah. Not in Canada, unfortunately. They didn't use to do it, didn't they? Use the American Express. Yeah, it's very interesting how Costco is, what's with that with the credit cards. Disney. Take a look. Can you take a look at Twitter? Yeah. So let's take a look at Disney quickly. So Disney, I have a contract. It's A6, and it's got like a gap here at 173. It also has a wolf wave. So I have one contract. Do you still have one contract, Mikael? So it's a paid for contract, and I have it for September. So we're gonna hold it into earnings. The next question is, can you take a look at Twitter? Twitter has a double D, almost triple D BLTs on the A. There's no A6. You have Disney, right? Yeah. So where it should be free, and you just hold. Do you also have? Does anybody have Netflix with me? So Twitter, I think you can find a better ideal trade setup, even if it rips up like 8% tomorrow, which I don't really think it will. I think it will rip up higher next month. That's because you can see the clear BLT on the monthly here. So if you're gonna try to trade Twitter, I would take a little bit of a more patient approach, where you just watch this monthly candle and see where it opens in August. And I don't know when their earnings are. Oh, they're coming up. So not much to trade in Twitter when earnings. There's not much left room for Apple to move up higher when you got earnings. So most of the trades are pretty much done now, and earnings is just going to be more smoke. So Twitter is a bit, in terms of whether Twitter beats earnings or doesn't beat earnings, I don't know. Based on this setup, it looks like it's going to beat. But I am not a professional in knowing if something's going to beat or not. You just have to, basically, in order to trade earnings for anything, you just have to figure out how much of the profits you have are you willing to risk, and then just give her. The next question is Disney. Roger, can you briefly explain the use of the importance of A6, A7? So the importance of understanding A6 and A7 is that, first of all, in the room, in the community, we should be consistent with the lingo and the wording. So A6 obviously means daily. A7 means weekly, and the importance of it is that actually I back tested A6 and A7 such that we can create the usage of cycles. So every candle in an A6, which represents a daily candle, it represents a cycle for that specific time frame. So when I back tested it, basically when something is scanning on A6, it means that there's those red dots, and then when it turns from a red dot to a green dot, which is what you're trying to anticipate when you're trading those setups, then you know that you're in cycle 1, and cycle 2 is where you should have a big chunk of those profits. In cycle 3 and 4, the depending on how extended it is, you can see a pullback come in. So I think, for example, if you take a look at SNO on the daily, you can see that SNO on the A6 here, it triggered time cycle 1 right here, but it made the breakout on that short squeeze, and it was a big 8 breakout. I remember it was like 8%. So after 8% and it didn't trigger time cycle 1, it's a little suspicious, and obviously you're managing profit. And then the reversal, because of how extended it was, it pulled back into cycle 1, 2, and 4. Now it's back to scanning. So the main importance is that with an A6, we can define cycles for that time frame, specifically for that time frame, and then assume a cycle 1 is going to give us profits with max profits expectation on cycle 2, and then look for a pullback or profit taking coming in on cycle 3 and 4. So it helps us understand the time component. Didn't think it was going to go over 390 this week. Effed up, never mind. Yeah, so next time I think like you can, putting on a spread is great when you don't have an ideal trade setup, because the ideal trade setup is more for momentum based trades where it's taking off. So you want to find those, and when you want to take a spread, you should take a spread when you're kind of going into cycle 3 and 4, right? It's like kind of gonna chop. When you're catching the ideal trade setup, you want directional. Quick question regarding the kicker. Would one of the long wick down closing the gap in pre-market be a good confirmation that it'll run at the open? So if the long wick gaps down in the pre-market, that's a good candidate that it will move higher, but that doesn't necessarily mean it's a kicker. But the higher the bigger the gap, as long as there's a gap above the previous day open, like a really big gap, then a kicker is going to work out. The gap fill, I think you're talking about the gap fill, is a sign that it'll move higher, but it's not really necessary to have on a kicker. The kicker just has to, the magnitude of the kicker will determine the magnitude of the move. So if something dropped down like 4%, then opening up 4% higher, like doing a 180, that's a kicker. It doesn't matter if there's a pre-market gap, wick. HR, here's one I just found using the scanner, but has a long D Wolf Wave scanning A6. Wolf Wave. Options, August 2035 calls are basically free. That is right where the Wolf Wave target is. Okay, let's take a look. HR on the daily. Yeah. So got the A6, got a short squeeze potential, earnings $30. Let's turn on the Hikinashi candle. The Hikinashi candle is still red, so, and then so I see what you're saying, and it's still valid. However, It's got the red Hikinashi candle. So when you get into a situation like that, turning off the Hikinashi candle. So that was the buy signal on the 12th. So you would have bought, let's say you assume that you bought it because it's it would have been a green Hikinashi candle here. And then now it did a complete reversal. So when you turn off the Hikinashi candle, it opened lower and created this dark cloud. And now it's so in situations like this, when it's chopping like that, you can first go to the Hikinashi candle and see that it's red. And if the next one is red, like opens lower, it'll start to trend like this off that A6. And that's not the greatest thing to have with that A6. So because it has potential, it's saying like it's going to make the move on January 31st, and it had triggered the long here, but the Hikinashi candle is what is going to give you that trending type of parabolic move, and right now it's kind of paused for now. So it can change tomorrow morning. It might like open up. It's going to have to open up above $30.57 in order for the next Hikinashi candle to show its centroid to be higher than the previous. And then that would create the next green candle and have introduced the run-up potential into earnings. So until you get that Hikinashi candle setting up as green, right now it's red. So you can also see the A6 here still under 0, whereas the look-back period of 14 is above 0. Conflicting signals, and it is making a higher low. Would be nice to have a bit of a Darvish channel there, but that's fine. 78-minute TT and squeeze also has a wolf wave here too. Let's take a look at HR. I don't see. Oh yeah, there's a huge long yellow D. So that's what you mean by long D. That is the longest D I have ever seen. That's what she said, right? So that's 478 days. So that's the second longest D, next to, what was the other D? Oh, Stamp. Stamp was the longest D. So Stamp was I thought I saw Kathy Wood come in with the eggplant. Yeah. Oh, wow. So actually HR is the longest D. So that HR is the longest D. It's making higher lows for sure. And then let's look on the 2D. It's got, yeah, so 2D with the Hikinashi candle, doji. Momentum is still hard to tell. So with this one, I'd be a little bit careful. I don't know why it's so messed up. And then weekly looks pretty bullish, but the momentum is still not there. Monthly, not the greatest. It looks very complicated. Why is that? That must have been a pretty boring stock to trade for the past 2 years. I don't know. I guess with the earnings coming out, you can catch a run. It could work. Maybe there's some news. I don't follow this company, but there could be some news. I think it's pricing in some news. Healthcare Reality Trust Incorporated. I'm not sure what that is. It looks like another investment trust fund that can launder money for the rich people. I don't know. But yeah, that's a pretty long D. So I would probably for me, I'm not really too particularly interested in trading double digit stocks because they're just they're not that great. Like if you think about weeklies on Thursday and Friday, you want Amazon moves, Google moves, but this one, 30. This is long term. Probably want to go in the money if you take these things. HR. Holy cow! Look at the spread. Yeah. If you take a look at the spread on these things, have you seen it? Which one do you have? The August 20 August. The what contracts? The $35 calls at 5 cents. Is that you? Did you buy all those 100 contracts? How many contracts did you buy? You did. I don't know. Oh, you don't have any? Yeah, look at the spread. It's pretty nasty, but I mean, for $50 at 100 contracts, definitely suspicious. I would actually call that unusual option activity. Look at it. It's like so unusual. It's like the only I mean, how come dark quant data doesn't like tell us that there's like 100 shares of I mean, their filter is kind of weird. There's out of this whole entire option chain, somebody bought 100 contracts. It's the only activity there next to the 3 contracts they bought for February. I would probably think that's unusual activity. So, I mean, that could be a lotto trade. 37 days for it to break out of that. Assuming that it breaks out on the weekly and the daily and moves up to 30, up to the top of that Darvish channel on the daily, which would be essentially $2 move for those contracts. Then basically, if you buy those contracts for 5 cents, how much are these? 5 cents, and they move to $2. I mean, that's a $50. That's a lotto right there. Yeah, thanks for bringing it up. It's a very interesting lotto. $50. Am I doing the math right? Jeez, I haven't traded a 5 cents contract in a while. But yeah, it's is it $5? So $5 per contract. So $500 gets you a potential, you risk 500 to make $20,000. So basically, if you want to guarantee a loss, then you'd buy those. That's a guaranteed loss. If you buy those, you're not going to get your money back. I'm pretty sure you're not going to get your money back. I don't think anyone will buy it back off of you. I don't even think you'll be able to get, I don't even think you'll be able to buy any contracts. There's no open interest, right? Let's take a look at the open interest. Oh, no, you will be able to buy it. Well, could. Yeah, $2. If you get 2 contracts, it goes up to, you buy 2 contracts for 5 cents each. That's $10. And then they go to $2. Then, if my math is correct, you make $400 for $10. I mean, that's a pretty interesting trade right there. Maybe you have anybody that works there? Yeah, so it's like, how does this company exist? Looks like it just one big chop fest. Yeah, that's a not a bad looking yellow D, but obviously we don't know if it'll just keep on chopping into earnings. It could just keep on doing this for the next 10 years. It's just probably need to know more about the company. But that's 1 year of, like, if you did back testing on this whole entire year, you'd find nothing. So basically when you do the back testing, it'll just tell you not to trade it. Okay, so finally, just to kind of wrap things up with the, we'll just go through quickly the Roku. So Roku's Hikinashi candle is not looking so hot. Okay, so we'll have to see how it opens. Maybe we get lucky on the inside day. Okay, that's what we're looking for. So the game plan for tomorrow is to watch for the first 30-minute candle to see if it tries to attempt to trigger the TGIT. If not, then we got to get out with a loss and then reset. And then for this Tesla, it's also got a red Hikinashi candle, so that could also flop. Not looking good for a lot of these techs, and the trading day today was a little bit suspicious, where only the companies, well, the FANG stocks, mainly the FANG stocks, are up, and we want to be careful of the potential market doing this again, because that was not. Today was not a very easy to trade market when we're relying on the VIX showing us risk on and risk off. Trin is at like 0.8 at the open, showing potential power hour rally, but then all of a sudden flipped to going up higher. Very confusing. So I'd be very careful. So, and then we're just finishing up the focus session. Here's the PowerPoint presentation. So I'll post this as soon as I'm done, but here's the trading plan. We have two cases tomorrow with Jay Powell and the president speaking tomorrow, pump and dump and pump. And these are the current positions that I have. And we're looking to try to look for the next compounding plan, such that we can start off with the seed money of $825 or whatever the amount that you have calculated based on the position sizing, and see if we can grow the account on the next compounding trade. All right, so thank you very much for your time, and once this video is done processing, I will post it. See everyone tomorrow morning.